PPI reports, yes, it was positive, but I don't think it is any kind of game changer for the Fed.
The Fed needs to keep expectations for where terminal rates could be or for where the next hike is.
The Fed's got to go back to inflation targeting, not average inflation targeting, but plain old inflation targeting.
The historical data does not suggest that the Fed is terribly adept when it comes to landing the plane gently.
We're not in a recession now, but it's coming, and there's going to be a calm before the storm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Stay tuned for 3 hours of being abused for taking vacation. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative 0.5%. TK, let's save the vacation banter for a moment. That data out of China, wow. Downside surprise after downside surprise.
So much to talk to here. I like what Ben Laidler says. It's the quietest week out there. It's before Jackson Hole. It's before this. And we needed China to give us a pick-me-up. John, this is important. Their economic experiment, it fails.
Or maybe a reality check. TK, the rally we've had in this equity market has been pretty stunning. We added it to again last week. I think, what's that, 4 weeks of gains now?
It's
longest weekly winning streak of the year so far.
Well, it's 4 weeks of gains. Lisa and I covered that with completeness with Kaylee Lyons last week, John. And, we saw the upfield of the market, but it was the way it was up. There was a persistence of the bid, John, that you could see in Naples, in Rome, up to Edinburgh. I know you saw AC Milan. It was a good trip around the continent.
I was watching Chelsea Spurs yesterday too, Tom. We can pick up on that a little bit later.
Let's do
Lisa,
that later.
Just going through the data, retail sales, industrial production, ugly, ugly, ugly. Unemployment for the youth in that country right now in China. That is not a pretty picture for the Communist Party.
16 to 24-year-olds. The unemployment rate is 19.9%. Basically, 1 in 5 young people in that country do not have a job. How much does this really affect what the People's Congress is going to do later this year and the end of zero COVID as well? Because how much can stimulus really shape a market that is dead from a complete lack of transactions because of the zero COVID policy?
So weakness in China, Lisa. You throw in Europe as well. The global economy, with the exception of some of the data we've had from America, the global economy is in a difficult spot.
Which raises a question of how much the U.S. can remain in an exceptional spot. And this is something that we heard from a lot of the notes overnight. There was a little bit more constructive tone to some of them, not, of course, Morgan Stanley, saying that actually it's getting closer to their bear case being a reality of a likelihood of recession in the U.S. and a high likelihood in Europe.
What did Mike Wilson say? The risk-reward remains unattractive. Good to be back. Mike Wilson saying that. I actually missed it last week. I saw that Marco over at JP Morgan, did he trim stocks?
Well,
just a little bit?
Yeah, but he still was bullish.
Okay.
He trimmed stocks, but he was still bullish. He was just saying it's good to hedge with commodities because they'd gotten beaten up. It was just really nuanced. I'm not bearish. I'm still very bullish, but maybe reduce risk.
I was on the Bloomberg Anywhere. I got excited just for a moment.
I know.
Futures negative, 0.5% on the S&P.
When you're sitting in the airport at Edinburgh on your way to Milan, what else are you going to do but look at the Bloomberg?
On the Nasdaq down 0.4. That's what everyone does, Tom.
Yeah, I know.
Yields up not even a basis point, 283.67 on a 10-year. Looking at euro dollar at 102. And look out below crude and copper for that matter as well. We'll pick up on this a little bit later. Lisa, WTI 88.30.
And how much does this really stem from exactly the story you were talking about, that weaker than expected economic data out of China having pretty big ramifications for the global appetite, at least the perceived one, for commodities. 8:30 a.m. Here's what we're looking at. August Empire Manufacturing. This is basically the first read on the manufacturing activity after a PPI report, as well as the ISM data that came out over the past few weeks, actually showing a bit of an upside surprise. Small business optimism, though, has been dead in the water. You've seen a slight uptick, but you really have not seen this faith that things are going to get better. How much do you see that reflected in perhaps a tone of optimism in the Empire Manufacturing Survey or not? 8:30 a.m. This, to me, I was watching over the weekend. Yesterday, Saudi Aramco reported blockbuster earnings. They reported record revenues. Just to give you a perspective, quarterly net income rose 90% to $48.4 billion. At 8:30 a.m., they give their earnings call. How much insight do they give to the demand picture? How much can we get both demand cooling and still prices remaining high because there just aren't the supplies to really meet that demand, even at a reduced level? And at 10 a.m., we get the latest read on home builder sentiment. We get the August NAHB Housing Market Index. How much do we see that starting to tick up, stabilize? I mean, it's been basically a steady straight line down as a result of the high mortgage rates and just where prices are, John, given that people are starting to have a little bit more discretion with what they buy.
A quieter summer schedule coming up this week for once. It makes
I like
a difference.
how you sum that up. Basically, there's no news.
I'm not criticising what you just did. I'm just saying retail sales later this week, just a little bit of peace and quiet ahead of Jackson Hole, maybe.
It's a good week to regroup and recalibrate before Jackson Hole in the September meeting. I'm sorry, how many people, John, have missed this bull market?
Plenty. Is that what you're calling this, Tom?
I'm not calling it. I'm just, when you're in triple leveraged cash, you really don't care if it's bull or bear.
I'm just checking in. Kit Jukes joins us now, Chief FX Strategist at SocGen. Kit, the first line in your note this morning, are markets listening to the Fed and ignoring them, or just not listening? Kit, which one is it?
I think they're choosing not to listen. I'm sure markets are listening to the Fed, but they're not really hearing the message, or, there's a disconnect between some of the kind of optimism that a little bit less inflation means we'll get less from the Fed, and a Fed that's looking at high inflation anyway, I mean, way, way, way too high, and a labor market which, is just incredibly tight now. And so they really have nowhere to go. And I will be surprised if we don't end up pricing a 4% Fed funds peak into this market before we're done over the next few weeks, because it seems to me that the message from the Fed is it cannot soften at all at this point.
Kit, what is the message of strong Swiss franc and particularly Euro Swissy breaking through 0.97 to 0.96? What is a signal of that sticking out like a sore thumb on a Monday morning?
It tells you a little bit about risk aversion. I mean, it tells you something about the fact that the Swiss decided that they wanted to get rates back into positive territory if they ever got a chance, and that they've got some inflation that they need to fight. And if they have to sacrifice all attempts to keep the currency down in the process, it's fine, because dollar Swiss isn't a problem. So domestically, you can see what they're doing. But yeah, I mean, it's an extension of the China story from this morning that says the U.S. economy might still be doing well so long as we don't look at the yield curve and don't worry about the things that don't gel well with the U.S. economy. But if we look at the rest of the world, there's just a world of trouble out there.
Kit, you're talking about how perhaps this market is not listening to the Federal Reserve. And I wonder in this quiet summer week whether Wednesday will be a pivotal day in terms of Fed meeting minutes, whether they try to signal, hey, wake up, 4% Fed funds rate is actually a reality. Do you believe that this will be a catalyst for some sort of dollar strength, for more market disruption, as people kind of start to hear what Jay Powell was saying?
Hard to know for sure, because I think what the I think the last FOMC meeting was about stepping away from excessive forward guidance. So I don't know if they want to come back and steer us too hard. I think Jackson Hole's a different story, but I think they have a problem with the degree of over-precise forward guidance we've had from central banks in a very complicated and chaotic global economy. It just doesn't make sense. They should take the facts as they are. When they get them and move. They should have hiked in June last year, and so on and so forth. So I would be a little bit depressed if I thought that they were still using FOMC minutes to micromanage expectations. I would be more encouraged if they came out, having seen the payroll data and having seen everything that we've seen since this month. If they came in Jackson Hole and say, look, we have to get inflation back in its box, and we can only do that by putting some slack into the labour market.
And financial conditions just keep on easing, and that's been problematic. Lisa, I was reading through the notes last week, and pretty much every single note said the same thing. It looked like, to me at least, that we were equating peak inflation, Lisa, with peak Fed hawkishness. I'm not sure whether you can do that.
And a lot of people came out and basically said the Fed put is still a Fed call, and that the more that stocks rally, the more that the Fed's going to have to step in and do something to cause this to reverse. And how much is this going to become the reality and the talking point over the next few weeks?
Kit, would you summarise it as follows, as Lisa just called it? Is this a Fed call now? And does this Fed have to respond to this aggressive rally we've seen in this equity market, this aggressive tightening we've seen in credit spreads?
I don't think the market helps the Fed, but the reality is that inflation, that with the labor market where it is, and wage growth where it is as a result of that, inflation may drift lower over the course of the next 6-9 months, but they'll still have a problem because it's not going up back under 5% easily from here. So there's a two-stage. So I think the Fed's messaging in sense of the Fed's problem is they don't have a choice. The inflation mandate requires action, more action. The market does what it does. The concern is that as soon as the market thinks they might have done enough, that's when you look at it and you think, no, they just haven't. not until the data improve.
Kit, just quickly, as an Arsenal fan, did you enjoy two other London clubs just beating each other up for 90 minutes yesterday?
Oh, it was good entertainment, whatever else it was.
Kit Juice is Sotgen. Kit, thank you. TK, what a game. Your tots. Antonio Conte.
It was great. I mean, it was, what's so cool about it, and we were talking about baseball, John, where you're gone. Baseball doesn't start like this. It's the second week of the season.
Thank you very much.
There's like 8 other stories. Kit, thanks so much for joining on Arsenal. But you look at the collapse of Man U. You look at Nottingham. Is Nottingham Forest? Is
That's
that right?
That's the one, yeah. Yeah.
Beating, the guy went from Richmond over to West Ham, and
that's exactly what happened.
Hasn't worked out. And I look at Thomas and Antonio. It's just sort of like surveillance.
What I love, Tom, about
great.
what you do when you talk about football, Lisa, it's what he does when he talks about markets too. He just blends the fiction with the reality. A bit of real talk about the Premier League, and then at the same time, Ted Lasso somehow ends up in there.
Oh, that was an outrage, John. That was an outrage at the end of the season when that lowlife went over to West Ham.
No information.
That was an outrage. They deserved to lose to Nottingham Forest.
By the way, he's still talking about Ted Lasso, just so everyone's clear. I love Lisa Shallett over at Morgan Stanley. I don't keep that a secret. I think she's absolutely brilliant. Here's the line from Lisa Shallett. Lisa, you'll love this. Let's get real here, people. Let's get real here, people, is the quote from Lisa Shallett this morning.
I love this because it really highlights this push-pull right now between the Bears, which Morgan Stanley has been solidly in the camp, and the Bulls that say, look at the technicals, look at where we are, things aren't that bad, and how much do we end up with one or the other winning out with the Fed pushing back against some of this optimism. I keep going back to that.
There we go. Lisa Shallett and you, best of friends, as I would have predicted. TK, it's good to be back. Thanks for such a warm welcome. Tom Keene.
It's wonderful
Lisa
to have you
Abramowicz
back.
and Jonathan Ferro. Thank you.
We're
Team's
very
back
happy.
together. Bramo's going on vacation on Wednesday, I'm told.
Yeah,
so the
that's
team's
right. So you
together
can make fun of me.
for a whole 2 days. Futures down a little bit on the S&P from New York City this morning. Good morning. Coming up, I'm told Anne-Marie Horden has a new studio down in D.C. And we're going to see what that looks like. And I'm told, Tom, it's better than us. So I'm looking forward to this.
Diva.
I'm looking forward to this in just a moment. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In China, the central bank unexpectedly cut its key interest rates. The People's Bank of China is ramping up support for an economy that has been hurt by COVID lockdowns and a deepening property downturn. New data shows that home prices fell again in July. Meanwhile, industrial output and retail sales were weaker than expected. Another U.S. congressional delegation, this one led by Democratic Senator Ed Markey, is visiting Taiwan. China says it is fighting back by adding more military patrols around the island. The congressional trip comes less than 2 weeks after the one by House Speaker Nancy Pelosi, which led to unprecedented Chinese military exercises. The climate crisis is compounding Europe's worst energy downturn in years. In Germany, the water level at the key waypoint on the Rhine River is set to steady at an extremely low level this week. The Rhine is Western Europe's most important river for the transport of fuel and other industrial goods. The river is now at a level where barges find it uneconomical to transit past that waypoint. It is a giant shift for Wells Fargo, the bank that once churned out 1 in every 3 home loans in the U.S. now plans to shrink its vast mortgage empire. Bloomberg has learned Wells Fargo is no longer committed to ranking #1 in the business. That comes after years of struggles to avoid costly probes and hits to the bank's reputation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
No one is above the law. Donald Trump is not above the law, and Attorney General Garland is not above the law either. And Congress has the powers of oversight. He needs to comply.
The law is king. The president isn't king. And I would add to that, the former president isn't king. Everyone has to follow the laws.
I'm urging all my colleagues, don't prejudge what we don't know about yet. And I'm also urging all my colleagues to understand the weight of your words and support law enforcement no matter what.
Reaction from Congress to a former president in some hot water. Live from New York City this morning. Good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your market shaping up as follows. Futures down by 0.5%. The data out of China weak. On the Nasdaq 100, we're down about 1/3%, coming off the back of 4 weeks of gains on the S&P, the longest weekly winning streak of the year so far. And Tom, we've taken back 50% of the drawdown off the highs. So we've taken a big bite out of that market route.
Yeah, the technicals here now. Full discussion, full description, John. I'm not a big fan of Fibonacci retracements, just so everybody understands that. But it was made a big splash of when you were. I don't think you were at Milan yet. You were still in Rome, but it was a big deal that we went through the 50% retracement.
It's quite a run, Tom. We're going to be picking up on that a little bit later. Also talking about what's happening in the commodity market too. I want to keep hitting the drum on that. Crude at 88, down by 4.3%. It's not just crude, it's copper too. So commodities today, just on my Bloomberg screen, a lot of red, Tom, getting hammered.
Yeah, off of China. And again, West Texas Intermediate, 88.06 is stunning, down $4 large. Right now, to move forward to a Monday morning after the shock of all we learned last week about this, that, or the other thing with former President Trump. Anne-Marie Horton joins us from Bloomberg in Washington with a morning briefing. I like what the New York Times did this morning, Anne-Marie. They sort of moved the story forward by talking to people that were actually in the offices. John Bolton was scathing in Maggie Haberman's article that he knew nothing about any of the shifting stories that we hear from President Trump. Simply, on the desperation of the moment for various parties, what's next?
Well, when you talk about the desperation of the varying parties, you see the Republicans struggling to really coalesce on how they are going to message this in a unified way. You saw some temperament over the weekend from some representatives saying that this needs to be justified and why they decided to go into the former president's home. But many of them, including Representative Fitzpatrick, who was an FBI agent in his prior life, was saying how we should reserve judgment until we get more information. Because what you also have over the weekend is the FBI and the Department of Homeland Security issuing a bulletin letting law enforcement individuals know, and also government facilities, people who work in courts, etc., that there are potential threats against them because what we are seeing right now.
Well, what's the when? I mean, you just mentioned there when there's more information. For anybody on whatever side of this argument they are, is when Tuesday? Is when September? Is when 2023?
Well, we don't know. I mean, what you can see by large is that there's a bipartisan effort. We saw that from Senator Warner alongside Senator Rubio. They're both chair and vice chair of the Senate Intelligence Committee, asking for the information that was in these confidential documents, 11 sets of confidential, even above that, classified documents, because they want to see, for the Republicans, whether or not the raid was justified. But for the Democrats, it's really about the gravity of this type of situation and the questioning of whether national security was in fact compromised. But we don't know when. There's a big question of if we'll ever see the affidavit, if the panel could see the likes of this kind of information. But there's no timeline.
But, Anne-Marie, to your point that you started with, how much pushback is there within the Republican Party to tone down the rhetoric substantially in order to avoid some of the threats on law enforcement that we've been seeing, especially because they are the party traditionally of law and order?
Right, and the Democrats are taking every moment they can to pounce on that, saying, I thought this was the party for law and order. We are going to, in fact, be the ones that want to make sure that we are protecting law enforcement officials. I mean, the spectrum is very wide. You have Representative Marjorie Taylor Greene that's campaigning, fundraising on merchandise that says, quote, defund the FBI. And then you have others, obviously much more tempered, like we just heard from Representative Fitzpatrick on CBS's Face the Nation on Sunday, talking about that both sides should really withhold judgment until we get more information. And that is the struggle right now for the Republicans more so than the Democrats.
Both sides are trying to use this ahead of the midterm elections. How is it featuring into some of the polling that we've been seeing in terms of either giving a boost to the Republicans that still definitely think of former President Trump as a leader versus the Democrats who are trying to use this to rally people for the law and order kind of side of things?
Yeah, so far what we've seen is that they're using this as a messaging tool. I think until there's more information, it'll be hard to see exactly how the electorate feel. But by and large, they are showing up on party lines. The Republicans really want justification for this raid. They say it's unprecedented to go into a former president's home. The Democrats say it's unprecedented for a president to take home 11 sets of these highly classified documents. So the polling is likely going to, the Democrats are going to poll definitely on, or the messaging they're going to have is definitely going to be based off of the fact that they do not want to see another President Trump coming to office. They're going to be using this towards their case for that. But for the Republicans, it's going to be really an attack on the Democrats and the fact that they think that this is a politicized version of what the FBI and Attorney General Merrick Garland are doing.
Hey, mates, before you go, we've promised the world a tour of the new studio. You're going to give us a sneak peek?
Beautiful.
Do we get a little look? There
yeah,
we go.
Bring in the cam.
Studio AMH, Tom, named after Anne-Marie down in Washington, D.C. What do you think of that?
I don't think that's true.
With a desk, TK,
for
full
for
desk,
those of you
no
on
podium.
radio, her desk is
How do
like
you
the
really
size
feel?
of the desk at the Eccles building for the Federal Open
It's
Market.
very cool. Can we go down there, Tom, and we get some Fed officials around a table?
Well, yeah,
have a
we're-
little
you know,
chit-chat. Lisa can tell him what
scheduled to-
she really thinks about the Federal Reserve and what they've been up to the last couple of years.
I think we should do that. We should get down there and, you know.
And join Studio Anne-Marie. AMH, thank you. It looks awesome. Looking forward to the coverage down in DC as we approach the midterms. And Tom, developments over the weekend, just wow, for a lot of people watching this play out.
I think wow is the right answer. I think it was a nation, John, without question, in shock last week. Just truly, just simply historic. And the question is the path forward here. And I would say this morning, and particularly when you look at the Washington Post this morning, with essentially no articles on this on the front of the fold on the internet, there's a whole mystery here developing what's next. And I'm much more leaning towards we're going to know Tuesday or Wednesday what's next.
Well, Bramo, I think we're all hungry for some more details, aren't we?
Without those details, it's hard to talk too intelligibly about this, which is the reason why people are calling for a bit of calm in some of the rhetoric on all sides.
Bit of calm this morning. Futures down, let's call it 0.5% on the S&P. On the Nasdaq, down 0.4%. Live from New York City this Monday morning. Good morning. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance. Allow me to bring you a snapshot of this market right now, and good morning to you. We are slightly negative. We're down 0.5% on the S&P. On the Nasdaq 100, we're down 0.4%. Underperformance on the Russell, the small caps down 0.75%. Outperformance, though, in this equity market over the last 4 weeks, though. 4 weeks of gains on the S&P, the longest weekly winning streak of the year so far, and about 17% off the lows of 2022 now on the S&P 500. And finally, I get to say this, and I think we can all say this, good news is good news. If you put together decent payrolls with a downside surprise on inflation, I don't think there's any other way of colouring it. Lisa, good news is good news, and that's what this market's been responding to. Now, whether, Lisa, you think it's overreacting and going too far in the other direction, that's a separate debate.
Does a little piece of you die saying good news is good news?
Very happy.
Good news
I've
is
said it a
bad
million
news.
times. I cannot wait to say
bad news is good news. Well,
is good news.
Except good news is good news for everything, including bond yields going lower, which sends a different signal. So right now there's some pretty conflicted signals going on, even as good news for stocks is good news.
Yeah, and I heard from Citi and Bank of America last week, and both of them picked up on that inflation report. Elements of it still pretty hot, pointing to some stickiness through the rest of this year and a Fed that's got more work to do. That's picked up in a yield curve. Let's be clear about that. Let's take a look at 2s, 10s and 30s. 2s versus 10s, the difference right now, still negative about 40 basis points or so. Tom, we are still in pre-Misra's world with a 2-year at 325 and a 10-year at about 283.
I'm really glad you framed this. The path we saw here, I don't know if you're aware of it, John, but the Misra index, a 2s10 spread, went out almost to 50 basis points, a solid negative 49 basis points, a curve inversion. It's come back to a negative 43 basis points, and still that would be headline making, except we had that surge out near 50.
A little bit of data later this week. We'll look to retail sales to maybe confirm better spending with gas prices coming down. Look to the control group for maybe a snapshot of that. And we've also got to talk about this commodity market. Brent crude's down almost 5%. Copper's down almost
Yeah,
3%.
China.
And Tom, the data out of China is just ugly, and I'm not sure that rate cut is going to get it done for anyone.
Well, it's about economic might. People can't take holidays. And of course, Lisa, what this amounts to is when you take a one-day hols and you extend it across Europe, as John did, moving from Naples.
Careful, Tom. I'm about to take
Rome,
vacation, so
to Milan.
I know.
I have
you get what you
imported
throw.
the European work ethic to New York City, and
That's
I'm not
true.
embarrassed about it. I think
John,
it's
how
great.
was the AC Milan game? I mean, I'm glad you
4-2.
caught that Saturday.
We're back, Tom.
We're back.
We did well.
Yeah,
it's
very
nice. Good game.
John Ferro, thank you so much. Seriously, we begin our Jackson Hole coverage. This is not a normal Jackson Hole this year. There's something in the air. You won't know what it is until that Wednesday, that Thursday, when we begin to gather on that beautiful, truly extraordinary lake with a representation of the Kansas City Fed. Peter Hooper joins us, Global Head of Economic Research at Deutsche Bank. Peter, I want to vamp off Neil Schuring, who I thought had a great note at Capital Economics, where he trotted out the aggregate supply and aggregate demand curve. And we're not going to go into the vertical nature of supply here, but he said supply, supply, supply. Can a supply shock be cured that can come to the rescue for Chairman Powell?
Tom, supply shocks are always tough for the Fed. Output down, inflation up. But contrary to the view that supply is the driving factor right now, our numbers are telling us it's really become demand. Supply was the factor last year. My colleague Justin Widener has been doing a really nice job of getting into the data in detail and finding that as this year has gone on, it's really much more a demand-driven inflation that we're dealing with, and that is something the Fed can, in fact, handle.
Dr. Hooper, explain to our listeners, our viewers, why buoyant demand is a bad thing. 82.45% of them think economists and Fed chairmen are nuts if demand is a bad thing.
Well, what's the bad thing is what people feel, the pain that people are feeling at the grocery store, the pump, and just about anywhere you're trying to shop these days. Excess demand, when you do have some supply problems especially, is really what's behind this inflation fire that we're dealing with right now. And that's our view for some time has been that this is driving us into a recession eventually. The Fed is going to have to tighten enough to deal with it. So yes, demand is a good thing, but too much demand is really unwelcome at this point.
So, Peter, given that, how much conviction do you have that we have seen peak inflation, as so many people said last week?
The market has rallied around the sense that headline CPI has come down. Core CPI has continued flat at a high level. And underlying inflation, the trim mean numbers continued up. So yes, there is some good news out there, but the market, I think, is ignoring at least several factors that are really a problem right now. That underlying inflation, number one. Number two, inflation expectations. We had a little good news from the New York Fed recently, but Michigan is up, and the survey of professional forecasters is up substantially. So our measure of the Fed's Common Inflation Expectations Index is not good news. And then add to that, the labor market is still on fire. I mean, the last labor market report gave us wage inflation that continues to march upward, and unit labor cost inflation is approaching double digits year over year, which is really a problem. So there's been a little good news out there, but we're not paying attention to the really serious news that's going to be driving the Fed going forward.
There are a lot of potential risks for the U.S. economy, but arguably there are many more for the rest of the world, in particular Europe. And there have been a number of economists that have found it's basically consensus that Europe will go into recession as it tries to combat inflation that's north of 8%. Do you agree that Europe looks like it's in a much worse position than the U.S., or do you think that it's more nuanced than that?
My esteemed colleague Mark Wall, our chief economist for Europe, has been calling for a recession now for a while, and we do see things turning negative second half this year into next year. Overall, a negative for the year as a whole in 2023, and that is a combination of the energy crisis, the gas crunch hitting Germany and others pretty hard. the tightening of financial conditions as the ECB has gotten into the act, and they're not going to be backing off from inflation that's actually running even higher there than it is in the U.S. right now. So Europe is headed for a downturn. We're fully on board with that one.
Peter Hooper, what's the ramifications of another 75 beeps up, let's say in September, October, November, whenever? I guess we approach neutrality. You don't know where it is. I don't know where it is. But what is the actual ramification to citizens of the country of another big lift in rates?
Well, you can be thankful that the Fed is on the case here in a way that they should be. They are moving back, as you say, toward neutral. We think we'll be somewhere in the neighborhood around the end of the year, maybe first half next year, certainly. And that's going to, as we get above neutral, that is going to begin to slow the economy enough to begin to deal with this inflation. The cost, of course, is for the average U.S. household is going to be some pain on the job front. We are going into a recession, but the wider effect of high inflation is something we really have to deal with. So yes, Fed raising 70. We think it's a close call between 50 and 75 at the next meeting. We've been on 50, but certainly the risks we think still are toward 75, and that's going to get the Fed back where it needs to be sooner, which is better news for the economy down the road.
Peter, just quickly here, Stephen Major over at HSBC put out a note where he said one reason why perhaps the terminal rate will not go as high as many people had previously expected for the Federal Reserve is because of the amount of debt currently outstanding. It is just too painful. We've already seen it with the mortgage rates. How much do you see that as a constraining feature, and how much do you think that perhaps that's overplayed?
I think it's overplayed. I think certainly households, household sector balance sheets are looking very solid at this point. Banking sector is looking pretty strong. Yes, national debt is a problem, and that's going to be pain as rates go up. But we have to deal with the inflation problem, and that's a bigger issue. I don't see the recession that's coming. We think is going to be by historical standards on the milder side, in part because household balance sheets are pretty firm at this point.
Peter, always great to catch up with you, sir. Peter Hooper there of Deutsche Bank Securities, and Lisa, Steve Major, proponent of that theory for a long, long time. I think that folds into this idea that in the bond market for treasuries too, there is this self-fulfilling, self-limiting element to it, that the higher yields go, the more they have to back away, because ultimately the debt part that you describe.
Which is the reason why so many people have come on and said they have conviction in the longer term yields, even if on the short end, perhaps you could see that rise. The reason for the inversion, the reason why people think that we could go far south of Priya Misra's 50 basis point of inversion, 40 basis points of inversion, and get to 80 or 100, akin to 1970s.
Are we excited for Jackson Hole next week?
Oh, yeah.
Sometimes it's a snooze fest. This time around, John,
You
I
all
don't
in,
think
TK?
so. Yeah, I mean, I was talking to Mohammed, Larry, Olivier this weekend, and, they're upset they're not invited.
Well, that's my question, Tom. That's the number one question I have. I don't know if they are or not. I hope they are, because otherwise this is a convention for the people who were wrong over in Jackson Hole,
I will be more
Wyoming.
respectful than you. I think Michael McKee has our best relationship with the good people at the Kansas City Fed, but there's a tradition to this, John, which borders towards boring academic papers, but then it does blow up based on events.
I don't think it's rude to say that largely the FOMC has gotten a lot of inflation wrong as a whole. So how do they present the balance, the counterbalance to their views? How much of a back and forth do you see in some of the academic research? To me, I actually will find that fascinating. The academic research in particular, where is the emphasis? The risk of going too quickly now and torpedoing economic growth, or the risk of 1970s on repeat? That to me is going to be a massive indication to markets.
I love that quote from Tom. I will be more respectful than you. Is that in the small print for this show, Tom? In Bloomberg
I don't know.
Surveillance?
Lisa just went on there because I just want to talk Nottingham Forest.
You want to talk about Forest?
She's talking about Forest at Jackson Hole.
And West Ham.
Yeah, well, I think Nottingham Forest and I think the Nashville Sound should,
Is that going to be your team of the year?
The Detroit Tigers should be relegated. I'm sorry.
Okay, you've said that for a while. Michael Barr's not going to be happy about that.
I know, but, come on. It's exciting to see Nottingham Forest take out Nick Mohammed and West Ham. I mean,
Futures down 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. China has added military patrols around Taiwan after another U.S. congressional delegation visited. Beijing said it was fighting back against a trip led by Democratic Senator Ed Markey. The visit came less than 2 weeks after the one by House Speaker Nancy Pelosi. That set off an unprecedented wave of Chinese military drills around Taiwan. Now, Russia's President Vladimir Putin is offering to expand relations with North Korea. Putin sent a message of congratulations to Kim Jong-un's regime for its Liberation Day holiday. North Korea has been stockpiling artillery for decades, and this has led some analysts to speculate that it could supply weapons for Russia's war in Ukraine. In Russia, lawyers for American basketball star Brittany Griner have appealed for her 9-year prison sentence for drug possession. Griner was convicted on the 4th of August. She was arrested last February after vape canisters containing cannabis oil were found in her luggage. Saudi Aramco has posted the biggest quarterly profit of any listed company. Aramco followed other big oil rivals reporting a surge in earnings due to high crude prices. Net income rose to $48.4 billion in the second quarter, almost double what it was a year earlier. Tributes are pouring in for Anshu Jain, the Cantor Fitzgerald president and former co-CEO of Deutsche Bank. Jain's death was announced on Saturday after a 5-year battle with cancer. He spent 2 decades at Deutsche Bank and transformed it into a global trading powerhouse. Anshu Jain was 59. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
They are projecting at the moment, without knowing what's going to happen globally, that the price in the fourth quarter of this year per gallon will probably drop to about $3.78. So we hope that that's true, but again, it can be impacted by what's happening globally.
We all hope that's true. That was Jennifer Granholm there, the U.S. Energy Secretary, speaking to CNN over the weekend, live from New York City. Good morning to you. Here's a snapshot of the price action this Monday. We are down 0.5% on the S&P. On the NASDAQ, we're down 1/3 of 1%. Crude and copper commodities having a tough time of it this morning. 87.70 on WTI. We're down by about 4.7%. I can tell you, the data out of China, just ugly, ugly, ugly. Downside surprise after downside surprise, and a little rate cut in the mix as well, Tom, in response to some of this.
It's the mix, and it's also the calendar towards a party Congress. Elizabeth Economy at CFR, I think, has just been brilliant on this. John, I'm sort of surprised equities aren't down more. I mean, you mentioned the 0.5% move on the Dow,
sure.
0.5% move
well,
on SPX.
I didn't mention that. You did, but I'm with you.
Yeah, okay. Well, the Dow Future's down 166. You'd think they'd be down 300 points off China.
Well, the weakness in China is not a secret, Tom. It's not a secret.
Yeah.
Seen a lot of it through this year so far.
On oil, Ellen Wald joined, senior fellow at the Atlantic Council, and really quite good on particularly the mix of what's going on in Saudi Arabia. Ellen, thank you so much for joining us today. Should we get used to oil at 80 or 90, or are you with a school of thought that normal is much higher and we're just on borrowed time down here?
I'm not sure we're necessarily on borrowed time, but I do think that for the current picture that yes, higher is definitely a new normal. And when you look at the changes that are going on in the U.S. in terms of oil production and new regulations and different corporate outlooks towards increasing production, there's definitely a trend towards less dynamic responses to the market, higher costs in terms of production, slower increases in production. And so I think we definitely could be looking at a somewhat higher basis in terms of oil. And as you've been mentioning, inflation also does play a role in that.
Ellen, can I just pick up on some of this and ask you how durable this decline is going to be? We're south of $4 a gallon for gas in this country right now, on average. We've seen numbers decline every single day going back to the middle of June. It's pretty impressive stuff. Secretary Granholm over the weekend to CNN hoping it continues. Do you have that same feeling that it will continue?
Well, I think that you also have to remember that seasonality is still a very important component in gasoline demand and gasoline prices. And generally around this time, we do see a slight dip in demand. School is starting for large portions of the country, and the summer driving season is coming to an end. But I think that what will really give us a good sense of where things are headed in terms of gasoline prices and demand is as we hit the fall, as we hit September, when refineries have to go into their maintenance season. I think we'll get a good picture of whether demand is still strong, whether it's going to drop off, because typically prices decline. But will refineries feel secure enough to even go offline to do maintenance? Or will they feel pressure to keep churning out more and more barrels and kind of put off needed maintenance? And that could be a significant factor for gasoline prices for the rest of the year.
How big of a swing factor, Ellen, is COVID zero and China ending that after the National People's Congress later this year?
That would be a huge deal if China ended its COVID zero policy, because essentially the market is always kind of on edge. Is China going to shut down? Is this major city going to shut down? What's demand going to look like out of China? And to some extent, you get a little bit of a sense when they issue their import quotas, especially for the independent refineries, about how much oil they're going to be importing. But at the stroke of a pen, they could basically crush domestic demand. And so I think that if they do get rid of this zero COVID policy, I think that will be quite telling for the market, especially for the next year.
Well, but how tight is production right now? How tight are supplies? And that's, I guess, the question that I have is, how resilient is the market to a potential shock in demand one way or another? Right now, we're seeing cooling demand. How low would those prices be if it weren't for that tightness?
Yeah, I think we could definitely potentially see prices, down in the 60s if it weren't for that tightness. But on the other hand, part of the tightness is what is causing prices to cool down. The fact that they were so high because things were tight. And then we did see some demand destruction. We are seeing continued fears of global recession. Even if we do get more data out of Europe and Europe does plunge into recession, which I think most people think is going to happen, that doesn't necessarily mean that they're still not going to need oil, because electricity prices there are still so high, and that could cause them to switch to some oil.
Ellen, the distinction to me in, say, a given 100-page research report is the potential demand of the Pacific Rim, and even the Pacific Rim ex-China. Do you believe in that they're going to have the buoyant boom over 1 year, 2 years, 3 years? It's going to pop oil to a permanence above $100 a barrel?
I don't believe that that's necessarily going to be the case. I definitely think that there's room for an economic boom there, but I wouldn't say that that's definitely going to cause oil to stay above 100, especially if you're looking at, say, a major decline in European demand, if you're looking at economic weakness in America. Those could all be significant factors. And also remember that when the middle of December comes, or early December, that's when these sanctions on Russian oil are supposed to take effect. And I think that will be very telling for where oil's going in the next year in 2023, and how well these sanctions are actually enforced or adhered to.
The coast isn't clear. We've heard that a lot, haven't we? Ellen Wald there of the Atlantic Council, the brilliant Ellen Wald on the latest. Ellen, thank you. If you're just tuning in on TV and radio worldwide, this is Bloomberg Surveillance, of course. You know that already. Looking at the data out of China, it was just terrible. Industrial production, downside surprise. Retail sales, big downside surprise. And off the back of that, Bramo, commodities, just ugly, ugly, ugly this morning.
It was retail sales, it was employment, it was every aspect of the data out of China. And then it was the response. You talk about a rate cut, 10 basis points, which is basically window dressing, indicating they're going to have to do a lot more. But a lot of analysts are saying they can't really achieve real momentum, real growth with monetary policy. This requires something else, potentially even the end of zero COVID.
Well, what do you make of 10 basis points, a rate cut of 10 basis points?
It's not going to be effective, right? It's not going to get it done. No one thinks it is. Is it more a signal that more is to come?
TK, I think for you, this has been front and center more than anyone. You've talked about it. COVID zero in China without understanding where that's going? Can we really put together a decent outlook?
That's where I am. In full disclosure, folks, I'm colored by family members in China. But, John, I'm sorry, nothing matters but their garbage COVID policy. Nothing matters.
You're calling it that, Tom? Garbage,
yes, it's bad medicine. I'm not calling it that. Amish Adalja of Johns Hopkins and others, all the different good people we talk to who are legit medical pros say this is nuts.
I hope that he has actually said that.
Yeah, that's
We'll catch up with him and find out.
Someone else said it.
Futures down 0.5% on the S&P. On the Nasdaq, we're down about 1/4%. The loss is easing just a little bit.
John, are you going away next
as the
week
morning
again?
grows older? I'll be here, TK.
Damn.
I'm going away to Jackson Hole, Wyoming, with you. Are we calling that a vacation or a work trip?
Is that next week? No,
That's a work
That's
trip.
a work trip. That's
Yeah,
work.
it's a work trip.
That's work. Okay.
I mean,
Thanks
if you want to call it a
clarifying.
vacation,
No,
go ahead.
With the Fed? Absolutely not.
The CPI and the PPI reports, yes, it was positive, but I don't think it is any kind of game changer for the Fed.
The Fed needs to keep expectations for where terminal rates could be or for where the next hike is.
Fed's got to go back to inflation targeting, not average inflation targeting, but plain old inflation targeting.
The historical data does not suggest that the Fed is terribly adept when it comes to landing the plane gently.
We're not in a recession now, but it's coming, and there's going to be a calm before the storm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The band is back together. It's a beautiful thing. Live from New York City this morning.
okay.
Good morning, good
Welcome
morning
back.
to our audience worldwide. Thank you, Bramo. I'm not getting that from TK, am I? With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures negative 0.4 on the S&P. Tom Keene, the longest weekly winning streak of the year so far.
Yeah, it is. It's going to be an interesting week. We'll talk football here. We'll talk Jackson Hole, a big theme coming up for us. But, John, you're right. It is all about the equity market. Huge differences of opinion. And to start strong this hour with David Bianco is a good thing.
Looking forward to that, Tom. There was a great quote on this program last week. The difference between a bear market rally and something more durable, hindsight. Apparently, we've seen quite a run off the lows, haven't we?
Agree. No, I agree with that. And, I'm watching the mumbo jumbo go forward here. And I think a huge amount of this, John, is just how unloved this market was on June 16th, June 17th, and the easy money's been made. Now what?
This rally's not loved. Let's be clear about that. This bounce is hated in
yes.
some places, including over at Morgan Stanley with Lisa Shallett. Lisa, she said, get real. Mike Wilson said the risk-reward remains unattractive.
So how much of this has to do with fundamentals, the earnings that were not terrible? They've crossed the bar for the lowest potential outcome, but not phenomenal. But then also how much is this squarely about the Federal Reserve? The fact that you see people piling into longer duration treasuries. You have a yield coming down. This is basically easing conditions. How much is this counterintuitive kind of result completely antithetical to what the Fed would like to see and driving a rally that is unsustainable on its face because the Fed is going to push back and say, no, just stop it.
Evercore with a page out of Lisa's Gospel this morning. This is what it says. A tug of war over financial conditions. Lisa, they go on to say, right now the Fed is losing, and we think it will need to pull harder in the period ahead to avoid conceding more ground.
Go ahead, Tom.
That's a huge deal. I'm going to interrupt, Lisa, because the Bloomberg Financial Conditions Index is really, really good math. And this morning, John, it sustains ever more accommodative. That's a fact.
You interrupt every 5 minutes. There's nothing original about that.
No, that's just original. I'm getting set for the. You can't go to Jackson Hole, Lisa, that gloomy. Now you can go to the you can go to the Death Canyon Trail. Mike McKee takes that every year.
It's
actually pretty hazardous. Death Canyon Trail is no small feat, but the pro tip out there is don't pet the wild animals. Bramo's going to be out there, John. Oh, look at the little bear.
That's what Bramo's going to do.
That's what she's going to do. Pet the little baby Grizz, and then Grizz is going to show up.
Are we doing a family hike? Is that what you're teeing up?
I think we should. Yes.
Okay, we should record that if that's what we're doing.
From the Pioneer Grill to the set, and then just off the left of the set is the lodge at Jackson Hole Bar. That's my hike.
Can't wait. There's your promo.
Thank
Futures
you.
down 0.4 on the S&P. On the Nasdaq 100 with -2 by 1/4%. We should record it, sell pay-per-view, subscription, fight in Jackson Hole, Wyoming. Yields 282.76. If you're just tuning in, the data out of China ugly. We're going to be talking about that all morning. morning. And off the back of some of that ugly data, Lisa, crude lower, copper lower, WTI 87.88.
I love that that's the new martial art, is us trying to take a family hike with a bottle of Tang. Okay, here's what we're looking at. This week is going to be an interesting one when it comes to retail sales, when it comes to the Fed meeting minutes on Wednesday. A bit softer in terms of some of the data. However, today we are looking at Empire Manufacturing for the month of August. It is usually the first initial read on what's going on in the month that comes at 8:30 a.m. at the same time that we get Saudi Aramco's earnings call after reporting record profits. Just giving you a sense of how high these profits were. Quarterly net income rose 90% to $48.4 billion. That is net income. And it comes as they see demand continuing to increase for oil, despite some of this goals of trying to reduce fossil fuels. You are seeing prices roll over, as John, you were talking about, because of what we're seeing with China. But how much, I keep wondering this, how much is this tightness in the oil market going to continue to drive prices higher, or at least keep them where they are despite a lack of demand? And at 10 a.m., we get the latest read on homebuilder sentiment with the August NAHB Housing Market Index. How much does it start to stabilize as we see stabilization and even a decline in mortgage rates? But John, this really goes to the heart of the issue. Mortgages are starting, the rates are starting to come down, even though the Fed has not backed away from its easing. How does this make sense? Is this going to come off too soon at a time when rents are still rising at a pace that is way beyond what the Fed would like to see?
As Evercore said, that is that tug of war over financial conditions. Into Jackson Hole next week. Lisa, thank you. Joining us now, let's get straight to it. David Bianco, CIO for the Americas at DWS. David, your words, you think this is a bear market rally. You think we're going to retest the lows later this year. So, David, I need the why, and what should we do in between?
Well, the why is fairly simple. The Fed's not done doing its job. They need to hike further. The economy's going to slow, likely contract. And the U.S. economy is kind of the best show on the planet. The world economy is in tough shape. So our view is that unless you believe the PE multiple of the S&P can be sustained at 20 or higher, with the deceleration in earnings growth that we see ahead to no better than the inflation rate, it's not an attractive reward for the risk. We do see things that investors can pick up here and there, but our view is that it may be a soft landing for the labor market. It's likely to be shaky and shakier for GDP. Risk assets are still quite at risk for a hard landing.
What's your conviction right now, David, considering that people are saying this, but then they're staying in their positions? Are you starting to sell some of your riskier positions, or are you basically just staying where you are?
Well, we have de-risked earlier in the year. We've stuck with that position. We think investors should keep cash at higher levels until we get past the autumn. The thing about corrections, we've already had a sharp one this year. Corrections kind of love company. They come in pairs. They come in bunches. You can go for many years without. Then all of a sudden you get a few. I think we get one more this year. From there, I do think the S&P can rally to 4,100, 4,200 by the end of the year. But I'm also still concerned that the longer-term outlook for the S&P is no better than inflationary-type gains for the next several years.
What I'm seeing is a narrowness here. Some would say a partition, but what I would do is take it to sector analysis, wrapped around factor analysis, wrapped around the fact quality's winning right now. Can you have a bull market if only a little bit of the market goes up?
Well, you need tech to rally, and it sure did the past several weeks, which is why the S&P...
Yeah, but if I get tech to rally into 2023, is that a bull market? I'm not sure it is.
Well, everybody would appreciate some breadth and some alternatives to the big cap tech names that have done so well, and including in this rally. I am a macro-minded investor. I like to find macro factors, and I tend to translate that into sector and industry preferences. I would point out what I think is one of the most underappreciated macro plays out there: utilities, electric utilities. In a world where natural gas is the essential commodity for the 2020s, in a world of electrification of vehicles, and in a world where people want inflation protection and income, the dividends.
Right.
Utilities are the low-hanging fruit in what is still a very risky macro market.
Right.
What's the correlation with rates there, David?
A high correlation, particularly with real interest rates. But part of the reason why the equity market's done well over the past several weeks is that 10-year TIPS yields came off their highs and 30, 40 basis points versus 70, 80 basis points earlier in the summer. So I'm not too worried about interest rates affecting utilities. However, because of the sensitivity at technology, stocks. I think that's still a relationship to monitor.
David, I want to get to a macro factor that is being discussed, particularly this morning. China's weak. Europe's going into recession. Everyone's on board with that theme into year end. What does that mean for American markets? Can we decouple from the rest of the world? Do you remember that conversation of 10 years ago? Right. Do you see that taking place?
Yeah, that's right. The decouple word, we're not supposed to use it. But there has been very much a delinking between the U.S. and the Chinese economy. And I think it's important to remember that this decade is very different from the decades, the past couple of decades past. And while there are energy shortages and the risk of disruption for natural gas into Europe, this is not a commodity boom from the demand side. We already see oil below $100 a barrel. I'd pick your spots carefully within commodities, and I'd pick your exposure to China very carefully. We like China tech for the long term and brave at heart. But China's economy is slowing down greatly.
David, that is brave. The regulatory call, you're not concerned about that?
Well, we are.
Don't you think you put money to work in China on the tech trade? Aren't you just vulnerable to a decision any given morning?
Yeah. I would, as I said, for the long term and for those who believe in peace and rational actors amongst policy setters in China and the United States, tech here and tech abroad is very sensitive to rational policies.
That takes a lot of faith right now, that's for sure. David, thank you. David Bianco there of DWS with the trade for the brave. Lisa, at the end of that conversation.
I love the way that he framed that, basically saying if you believe in peace, if you believe in prosperity, if you believe in democracy, I mean, how much are you looking at faith-based investing going forward, not just when it comes to China, but even in terms of what the new normal will look like, that it will replicate something akin to the old, even in a place like the United States.
Just to paraphrase David Bianco there, Tom, the U.S. economy, the best show on the planet, in rough shape at the moment.
I believe, you've heard it, John. It's like a broken record on a Monday morning from me. I believe corporations will adapt. It's all there is to it. And frankly, the nation will adapt. We haven't even addressed massive legislation by the president, where you love it or hate it, whatever the politics is. In some form, that's going to be a fiscal stimulus.
Well, Tom, we're drowning in a different kind of politics down in Washington.
Well, it's a different
moment,
kind.
Aren't we?
Yeah, Anne-Marie will touch on that, I believe, here in a few minutes.
Anne-Marie coming up from our new studio in about 5 or 10 minutes' time. Futures right now, -0.4 on the S&P, on the Nasdaq, down about 0.25%. We have taken out about 50% of the correction of the year, the drawdown so far, Lisa, and we're getting a lot of pushback off the back of that rally.
I love the idea. Hindsight's the only way you're going to know it's a bear market rally, but it does seem highly uncomfortable given that the economic data hasn't turned around in the way, at least when it comes to inflation, that many would like to see.
Surprised in the right direction, though, over the last couple of weeks, that's for sure. Futures down 0.4 on the S&P off the back of this bad data out of China. The Nasdaq softer by 0.2%. Yields aren't giving me much. We're unchanged at 282.58 on a 10-year. From New York City this morning, good morning. Coming up a little bit later, Lisa Hornbier-Schroeder's looking forward to that. Up next, it's AMH down in Washington. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Another U.S. congressional delegation, this one led by Democratic Senator Ed Markey, is visiting Taiwan. China says it is fighting back by adding more military patrols around the island. The congressional trip comes less than 2 weeks after the one by House Speaker Nancy Pelosi, which led to unprecedented Chinese military exercises. Now, in China, the central bank unexpectedly cut its key interest rates. The People's Bank of China is ramping up support for an economy that has been hurt by COVID lockdowns and a deepening property downturn. New data shows that home prices fell again in July. Meanwhile, industrial output and retail sales were weaker than expected. Members of Congress are putting pressure on the U.S. government to tell them what was in classified documents seized at the former President Donald Trump's home. Senate Intelligence Committee leaders have made a bipartisan request to the Justice Department and the Director of National Intelligence. They asked for an assessment of potential risk caused by the documents' mishandling. It's a giant shift for Wells Fargo, the bank that once churned out 1 in every 3 home loans in the U.S. now plans to shrink its vast mortgage empire. Bloomberg has learned Wells Fargo is no longer committed to ranking #1 in that business. That comes after years of struggles to avoid costly probes and hits to the bank's reputation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Merrick Garland would not be the president's lawyer. He would not be the vice president's lawyer. This is about the American people and doing what is right for the American people. The Department of Justice, when it comes to law enforcement, is independent.
That's Karine Jean-Pierre there, the White House press secretary on ABC over the weekend. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures are negative 0.4% on the S&P 500 off the back of 4 weeks of gains on the S&P 500. We have taken out 50% of the drawdown. We're 17% off the lows. It's been quite a run in both the Nasdaq and the S&P over the last month or so. Yields unchanged this morning at 282.76. I'll keep coming back to the commodity market for you because it's pretty brutal this morning off the back of some of the weaker Chinese data. Out of China, downside surprise. Brent down about 5%. WTI crude down about 5%. Copper down by 2.5%. Tom, WTI 87 and about 60.
And we'll cover that through the morning here and again through the week. Retail sales extremely important this week. Really, that's John, don't you agree that's the headline statistic?
Agree, Tom, but you've just got to look for any reading this week on retail sales ex-gas. Just to try and get a feel for the underlying story.
The control group. We'll dive into that this week. In the last hour with Anne-Marie Horton, our Bloomberg Washington correspondent, we mentioned Department of Justice and, of course, the uproar with the former president. Now I'd like to take a different tack. Anne-Marie, what I saw in the zeitgeist this weekend in a sleepy August, not as hot as the steamy July that we had, was discussions of civil war. Give me the tone that you see in all your reading and reporting of not a linkage of Biden to Lincoln, but just this impending sense of where we are, maybe like the autumn of 1859. Where are we right now in this nation with this percolation of a potential civil war?
Well, I think you have to go to the Friday bulletin that the Justice Department and Department of Homeland Security sent out to their teams, to law enforcement around the country, saying they are seeing a spike in violent threats, mostly coming a lot of this from social media, and also what you saw in Cincinnati last week outside an FBI headquarters. And this is concerns. What they see in these threats are terms talking about taking of militias and a civil war. So there are these concerns, and you can see it just from the bulletins that the FBI and Department of Homeland Security is issuing to their departments. The question is whether or not this continues to be a concern or does start to die down.
What is the power of the middle ground right now, dashing to the first Tuesday of November? I think we can talk about the middle ground of the Democratic Party, maybe represented by the president. But what is the power of more moderate GOP, or have they just given it up?
Well, it's difficult, right? And you're talking about the primaries. We have a big one tomorrow in Wyoming, and you have lawmaker Representative Liz Cheney, who the polls show is likely going to lose her seat to a very much so President Donald Trump-backed contender. So it's really this big divide within the Republican Party. You see that through the number of primaries we've seen amongst Republicans and whether or not how far these candidates were willing to go in terms of showing their fealty towards the former president to get his backing and whether or not that helped him or not. And it's kind of a mixed bag. But I think tomorrow will be one of those highlights where you do see a candidate that strongly supports the former president, that questions many of the things like the select committee that is trying to show his involvement in January 6th. So you have this division within the Republican Party, and I think what you're seeing in terms of what's going on in the search and seizure of Mar-a-Lago is they are struggling, right? Because as Lisa mentioned the last hour, this is the party of law enforcement, the party that wants to back and fund law enforcement, and they are in this very tricky, precarious moment because members of their party are talking about attacking those individuals and defunding them.
So amid this domestic political soup, Anne-Marie, how do you place the international soup of politics where you've got representatives from the United States heading back over to Taiwan, not an unheard of thing, and Nancy Pelosi was the highest ranking, but why are we having this in the mix right now with China now saying that they're going to extend some of their military drills?
So a lot of analysts will say that when you see lawmakers from the United States go over to Taiwan, it's a lot of virtue signaling back home, right? This plays very well into the politics, especially ahead of elections, to talking tough on China. For the past year, there's been about 33 lawmakers, or under the Biden administration, there's been about 33 lawmakers that went over to Taiwan. You don't always hear about it. It doesn't always get the kind of coverage that we saw from Speaker Pelosi because obviously of her ranking being third to the presidency. And this trip is very much so getting highlighted in the Chinese press because it is less than 2 weeks since Speaker Pelosi was there and we saw all the blowback coming from Beijing, which was sanctions on Taiwan, as well as live military drills, which likely included firing ballistic missiles over the island, even into Japan's economic exclusion zone. And what you are seeing today is the Chinese military talking about the PLA, the People's Liberation Army, preparing still for war, and they are now going to have more patrols, given that you do have this delegation there.
Anne-Marie, what does Taiwan think about all of this?
Well, it's mixed, right? So Taiwan has two of their parties right now. The one that is in power definitely leans towards the rhetoric of independence. But there's a number of people in Taiwan that really want to keep the status quo. They understand that they are tiny compared to China. Also, China is their biggest trading partner. And they don't want to see a war. And what they would like to see is the status quo. And our reporter, Samson Ellis, I think, put it very well a few weeks ago when Speaker Pelosi was on that trip, and he said the repercussions will not come to the United States. Yep. The repercussions will be faced by the people of Taiwan.
AMH down in D.C. Anne-Marie, thank you. Lisa, to Anne-Marie's point, and just to build on that, this is not new, but what is new is how China's responding to it, and they're responding to these visits with much more aggression.
And it's surprising that we're not hearing more rhetoric about how concerning that is. It doesn't seem like there is a feeling that there's going to be war. How many articles have you read? How many analysts coming out and saying China doesn't want a war? Neither does the U.S. Both of them are diffusing things on the sides, and there still is a talk of a Biden-Xi summit. How do you then place these sorties over Taiwan and the escalating military drills?
It's a complex moment, Tom. If you want a decent read on this, the former Australian Prime Minister Kevin Rudd, in an op-ed piece over the weekend in the Wall Street Journal, pretty tidy piece. Xi Jinping's reach exceeds his grasp.
Yeah, Mr. Rudd has been more than vocal about this. And of course, Australia has a unique position in this. You know, I was talking to Qantas about this. And of course, the view from Perth on Rudd is you know, a little different, but he has a real international weight here, and his comments are important.
Tom, just to be clear, you weren't speaking to the airline, you were speaking to your Australian producer.
Well, Qantas is, you know, his parents named him after.
Like, no, I was speaking to the airline.
It's either an Indian
just to clarify.
It's either an Indian tribe or a species of koala bear. I don't know which it is.
Honestly, if you don't follow this show regularly, you get confused pretty quickly.
Yeah.
Okay.
Can we talk about Man U when we come back?
Of course. Yeah, we'll do that.
Please.
Futures down, a half
Get
of
Lord
1%.
O'Neill on the phone.
This is Bloomberg. This equity market rally is confronting a wall of doubt. Lisa Shallard of Morgan Stanley saying, get real. Mike Wilson of Morgan Stanley saying the risk reward is unattractive. Futures this morning down about a half of 1% on the S&P after 4 weeks of gains on the S&P 500, the longest weekly winning streak of the year so far, and taking out about 50% of the drawdown in 2022. I believe we're close to 17% or so off the lows. The message from the Fed, the message from Citi, from Bank of America, we have more work to do at the Federal Reserve, and the yields look like this. 2s, 10s and 30s, Tom. Your 2-year, your 10-year, you look at those two versus each other, still negative, Tom. About 40 basis points, some deep inversion in that yield curve.
Oh, we look at the drawdown you mentioned, John, and that's always the media gloom. Let's look at the drop right now. John, you've got your math really well done. SPX up a solid 17%. Dow doesn't do quite as well. In the NASDAQ, John, from the bottom in June, up 22%.
You call it the media gloom, Tom, but it's not just the media. It's the whole of the South Side as well, with the exception of maybe Mr. Kalanovic over at JP Morgan. And I'd also say Chris Harvey of Wells Fargo summed it up pretty nicely.
He's been very good. Yeah.
Chris basically said that weakness you're looking for in this economy, push it out to early 2023.
Yeah, there's been a couple that
it's not going to come until the first half of 23.
John Stolfus publishes moments ago with OPCO, and he makes clear this is a market for the bears, the skeptics, and the nervous. And, you know, you wonder
That's
where that goes.
That's a good way of putting it. Yeah. I remember BNP Paribas in the last couple of weeks saying that maybe this can generate some crowding in. And I'm pretty sure over the last couple of weeks that more and more people are getting that itch.
Absolutely.
Getting that itch. What do they say? Price shapes sentiment. Sentiment doesn't shape price and all that good stuff.
Very good.
That's the bond market, not my line, Tom. In the commodity market, we look a little something like this. We are down Downside surprise in China after downside surprise in China. Ugly, ugly data. And before we got that data, they came out with the smallest of rate cuts. Crude is lower, 93 on Brent. Copper is lower. We're down 2.3%.
That's London copper.
That is one to watch.
On radio, that's London copper.
That's what we do here, Tom.
Well, we
follow
do Chicago
the LME.
copper, too.
It's
as
an
we look
international
over
field.
Yeah, I know. It is.
International.
That's good.
All right. That's your cross-asset price action.
356.
Some single names based out of London, operating elsewhere. Here's Bramo.
Oh, operating on the other side of the room. I'm taking a look, just spinning off the commodity complex. This is the story of the day, both with respect to the macro as well as the micro. And John was talking about that rally, that comeback, particularly in the broad indexes. Look under the hood, and there's been a whole lot of pain in the commodity sector. All of the miners, Rio Tinto, BHP Group, and Freeport-McMoRan have all been down more than 20%. Freeport-McMoRan down 27% before today even, since June 7th. This has been driving a lot of this feeling that perhaps we've hit peak inflation. This has been driving the fact that perhaps if you have a Fed put, or a Fed call rather, you have a commodity put on the market, giving it wind. You can see this also in the oil complex, seeing all of the major oil companies also declining in the face of lower oil prices today. You could see, for example, if you get a sense today of those movers, Exxon down 2.6%, Chevron 2.4%, Devon Energy down 3.6%. All of these also down in between 8 to 14% since that time. So giving you a sense, Tom, of just how much you've seen these come off, a reverse of the trade that we saw for the first half of the year. How much is this driving sentiment? How much is something that we have not been able to predict, and there's normally been a pain trade to try to gauge out the price of oil, to gauge out where metals are going to go? How much is that what's dictating the more benign mood in risk assets?
It headlines this morning, 5% move down in oil, 87.56 on American West Texas Intermediate. They've not gotten enough credit. Credit Suisse, at the bottom, amid the gloom, was forcefully optimistic. They've done a great job on equities and across the fixed income space in getting the post-pandemic rally right, leading their foreign exchange charge. Global head of FX strategy at Credit Suisse, Shahab Jalanous, joins us right now. And part of that optimism is strong dollar. You don't mince any words about it. Dollar gloom is not in order.
No, for us, the framework remains the same as it has been really for the past year, ever since the Fed made a hawkish tilt in June of last year. So what we're seeing at the moment is still clear U.S. outperformance when it comes to the likelihood of avoiding recession.
Right.
There's a lot of talk about U.S. recession risk, but the truth is the problems seem much more gloomy in Europe. And look at the Chinese numbers that we just had as well. How many other central banks do you know that are cutting rates? Today we had one from China.
Yeah, it was Teen Sweets. That is your dollar resiliency about capital flow into the United States, or is it about interest rate differentials?
Well, the two coincide quite often. So definitely there's a rate differential story that's still very dollar favorable. So that does tend to bring money into the U.S. But we've also liked the dollar from a terms of trade perspective as well. You've seen.
Explain that.
Well, obviously the high energy prices are coming off now, but the high energy prices that we've had, they've done tremendous damage to the trade balances of many countries, Japan, Korea, the European Union as well overall. And all of that has obviously caused lots of damage into terms of trade. And that's something that gets overlooked sometimes when we're looking only in terms of recession risks and where interest rates are. So there's two prongs to this, and for now, that's not likely to change in a positive direction. If oil prices keep coming off, people will see in that maybe a sign of change. But if the reason they're coming off is weak demand globally, that also doesn't tend to help the likes of China or the euro, for example, in the currency space.
Well, let's throw dollar China into the mix. You've got a target of 6.95, Shahab. After the data and the policy response, do you feel a bit better about that trade this morning?
I definitely do. Clearly, we thought there might be some kind of a short-term correction in favor of the renminbi once the heat died down a little bit around the geopolitical risk over the past week. But clearly, the economic data there remain even weaker than we were expecting, to be honest. And the rate cut today has surprised most economists out there. So our 695 call for us still seems appropriate. And really, again, as I mentioned, that was based above all on a divergence story. And as I said, with all the focus we've had on U.S. recession risks, maybe the market's taken its eye off the ball a little bit on what's going on in the rest of the world. So for us, that still seems the path of least resistance to go higher in dollar CNH.
Shahab, what is the character of this downturn in China? And does it go beyond just this COVID zero policy we've talked so much about?
I think it does, in the sense that clearly that's a big part of it. But there does seem to be, once you look under the hood, some sense that certain sectors are in trouble for different reasons. For example, the property sector, that's not entirely, I guess, about zero COVID. There's an element of it, but there's other issues to do with over leverage. And really, once you create a problem like China has by creating a weak growth dynamic in effect, it's quite difficult to get out of it. And you see that really when you look at numbers like credit growth that we had on Friday that were very, very weak. Once that credit multiplier turns off, in essence, it's quite difficult to reactivate it. That's what we're finding. We've seen that in many other economies as well. And I think that's where the Chinese are right now. If you add on top of that the ever-present geopolitical risk story now that seems to be something that's not going to go away anytime soon, that also obviously casts a shadow over the future too. So I think there's many different issues in play here. It's not simply a zero COVID story.
So amid all of this gloom, why is it that the carry trade in emerging markets has done so well, continues to do so well? Will it continue to do that through the remainder of the year, or will it become something a lot more painful?
I think some areas of emerging markets already are in deep pain. If you look at, for example, Sri Lanka, that's been in the headlines, not in any kind of a positive way. There's other countries like Pakistan, Kenya. So countries more on the frontier side of emerging markets, they've already been suffering. So this carry trade that you mentioned is definitely there for some larger economies that have benefited maybe from a terms of trade perspective, the likes of Brazil, where you have very high interest rates as the central bank tries to take control over inflation. But actually, they're few and far between, the number of markets that have really benefited from this flow. We're looking at the likes of Brazil, Mexico, to some extent South Africa. But I wouldn't say the wider emerging market space has been doing particularly well, nor benefiting from a general sense of carry inflows. I think it's a very select group of countries that we're talking about here.
Shahab, just quickly, just back to China, just to round things up. How should I respond to what they did this morning with rates? Should the signal be it was only 10 basis points, they don't have much here? Or should the signal be this is the first play of more to come?
Well, the Chinese tend to move in small increments when it comes to interest rate moves. You tend not to see 50 basis point or 100 basis point moves like we see now, for example, in Europe and the US. So I think really it's the direction of travel that's the more relevant factor here, particularly in a world where everybody else is busy hiking rates aggressively. So I think that's, for me, the key takeaway from this. And that keeps this divergence theme in play. And that's the most relevant element as far as currencies go, which is why, again, we have the 695 target for dollar CNH.
Shahab Jalanusa, Credit Suisse, quite a call. Tom, 678 right now.
Well, I was thinking about that, and like to get up to seven yuan is really something. I mean, if we see that kind of weak renminbi, that really straightens out a lot of different people. But I'm not sure, John, how managed that is. I mean, I go back and forth on that.
Well, to see a currency pair like that one move 0.7 to 1%, Tom, that's something you pay attention to.
Yeah. Yeah, I mean, it's been an evolution. I mean, if you get the chart up on USD CNY, the fact is it's been an evolution here as they deal with this. I go back to the front and center thing is everybody else has dealt with COVID, some good, some bad. We've all got our stories, United Kingdom, et cetera, and China just stands out in getting it wrong.
To Shahab's point, though, and I think this is important, Tom, I'm with you, focus on COVID zero. But Lisa, to Shahab's point, there's more than that going on. There's massive demographic issues. There's real estate problems that aren't just going to be solved by COVID zero on, off, whatever it is.
And there's also this goal to deleverage. They're not as willing to throw leverage into the system to try to support growth. And you've seen that, the 10 basis point move, really tepid. Yeah, it might signal more to come, but it doesn't necessarily signal a roaring all in that perhaps had been in the past. And that 7 level we had seen in 2019 and 2020 ahead of the pandemic.
One man who is awesome on all of this is Bill Lee, the chief economist of the Milken Institute, and we'll catch up with him in about 50 minutes. We'll do that at 8:30 Eastern Time. Futures down 0.5% on the S&P. On the Nasdaq, we're down around about 1/3 on the Nasdaq 100. Yields not doing much, 282.40. And off the back of that terrible data in China, crude getting hammered, $87 a barrel on WTI. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. China has added military patrols around Taiwan after another U.S. congressional delegation visited. Beijing said it was fighting back against a trip led by Democratic Senator Ed Markey. The visit comes less than 2 weeks after the one by the House Speaker Nancy Pelosi that set off an unprecedented wave of Chinese military drills around Taiwan. Now, Russia's President Vladimir Putin is offering to expand relations with North Korea. Putin sent a message of congratulations to Kim Jong-un's regime for its Liberation Day holiday. North Korea has been stockpiling artillery for decades. That has led some analysts to speculate that it could supply weapons for Russia's war in Ukraine. Minutes from the last meeting of Federal Reserve policymakers may reveal their inclination on the size of the next rate hike. Backing in financial markets has swung between 50 and 75 basis points. The latest jobs report boosted the odds of a big rate hike, while the CPI report decreased them. The minutes are released on Wednesday. Saudi Aramco has posted the biggest quarterly profit of any listed company. Aramco followed other big oil rivals reporting a surge in earnings due to high crude prices. Net income rose to $48.4 billion in the second quarter, almost double what it was a year earlier. And tributes are pouring in for Anshu Jain, the Cantor Fitzgerald president and former co-CEO of Deutsche Bank. Jain's death was announced on Saturday after a 5-year battle with cancer. He spent 2 decades at Deutsche Bank and transformed it into a global trading powerhouse. Anshu Jain was 59. Global news 24 hours a day, on air and on Bloomberg Quick Take. This is Bloomberg.
We debate how much China has held down U.S. inflation over the past 20 years, but it's been significant. And as supply chains are disrupted by China and other developments around the world, as we move from offshore to onshore, good luck in getting inflation down.
From exporting inflation to exporting deflation, or vice versa. Stephen Roach there of Yale on the latest situation with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures right now down 0.5% on the S&P. On the Nasdaq 100, we are down 0.4%. Yields unchanged at 282.22, and crude takes another leg lower. Guys, we're down by more than 5% now. 87.32, Tom, on WTI.
87.32, and Brent distant from 100, distant from 124. John, 93.19 for Brent to dip under 90 would be a huge deal.
Big turnaround, not just crude, Tom, but also copper as well, off the back of some of that data in China. Not great.
In Chicago, in Chicago, early trading copper 355, dipping under 356. John, I'd also note gold off $25, back again under $1,800.
What do you make of that, Tom?
China. I just think it's like, OMG, there's the China data. Let's do that now with Enda Curran, Bloomberg Chief Asia Economics Correspondent. Enda, let me ask the prescient question. Was this a surprise?
It was, because July was meant to be the month of recovery, Tom. The third quarter was meant to be all about China hauling itself out of the big lockdowns of the second quarter, getting growth back on track and getting some momentum going. But we saw weakness across the board. Retail sales came in much weaker than expected. Investment was softer than expected. In fact, private sector investment well behind public spending. We saw industrial output weaken, which was a bit surprising given the export story. We had more weak data points on the real estate sector in terms of investment and new home prices. And of course, all of that together then is what forced the central bank to cut its key interest rate for the first time since January now. That move in and of itself would certainly not be a game changer for the economy. The problem in China is not the price of money. It's the fact that nobody wants to borrow. But it does speak to the idea that China's economy now is slowing much faster than expected. And like I said at the start, July was meant to mark the beginning of the turnaround, but today's data has certainly corrected that narrative.
And how would you read that 10 basis point rate cut? I read a number of analyst reports saying, on one hand, that this suggests just how dire things are, considering that they do not want to ease policy. They do not want to fan the flames of inflation, even though it isn't as significant or severe over there. Other people saying it just indicates they are prepared to do so much more going forward. Which side do you weigh in on?
I think it has to come down to the latter, Lisa. I mean, they haven't cut this rate since January, despite everything that's happened in the economy. And that's partly because there's no shortage of liquidity in the financial system, for example. In fact, they even drained some money from the money markets today. And there's no shortage of loans available for banks and companies. The issue is that they don't want to borrow. It's not about the lending rate that's an offer to them. I think what it does symbolize, though, is that the authorities are now starting to pull whatever lever they have available to them. And on the central bank side, really, that's just about what they can do via the money markets, about trying to bring interest rates down and maybe take some pressure off, say, the real estate borrowers. But the big focus now is going to be on where will the policy pivot come? Will it come on COVID zero? And all the messaging on that has been no way. They want the public health dividend. They're not going to U-turn on that, at least not before the Congress. So then you have to ask, well, what's going to happen on the real estate side of things? Are they going to come in there and rev up those developers, finish those unfinished property projects and get some money flowing in that part of the economy? These are the big questions going forward, because a lot of economists said today that the July numbers were so weak, it's now changing their views for the rest of the year. Already August is looking weaker than they expected, and the back half of this year is already going to be weaker than what they thought a few weeks ago.
So what about the social aspects of this as well? We were talking about how basically 1 in 5 members of the Chinese society aged 16 to 24 are out of work. How significant is this for the People's Congress heading into that meeting later this year?
Obviously, all important. Nothing is more crucial for the Communist Party's mandate than, the social contract of economic uplift and jobs being created for everybody. So when you have this bracket of young people, that poses long-term structural challenges for the economy. Of course, it poses a risk of long-term damage to their earnings and potential. It's not helped by the fact there's a record amount of graduates coming on the recruitment scene this year. So it certainly is a bit of a crunch. Now, China is not an outlier in youth unemployment. Youth unemployment globally, because of the pandemic, is still higher than where it was before the pandemic. That's according to the ILO. So China isn't an outlier, but nonetheless, certainly mission critical for the party is creating jobs. They've said so publicly time and again this year. And I wouldn't be surprised if we do see more of a focus now on job creation schemes for that 16 to 24 bracket in the months ahead.
Andy, you nailed it, and I want to go back to it. Park the data from this morning. Park the central bank response. Go back to Friday. Aggregate financing out of China. And is this a liquidity trap? And how on earth do they confront it?
Well, that's what all the conversation is, John. I mean, it goes back to the money markets. By the way, they actually took money out of the financial system today. That was lost in all the news. That speaks to the idea that there's so much money floating around in there. That's not where the problem is. The problems are more structural, linked to this COVID zero policy and how do they back out of the corner that they are now in, or of course longer term structural around the real estate story. Where are they on the deleveraging debate? Are they willing to tolerate more debt? Are they willing to tolerate more risk there? Or how else are they going to rev up that? And then the bigger picture question about, well, what happened to the whole consumption story? It was meant to be all about China transitioning to a consumer driven economy, but consumers clearly are nowhere to be seen in this recovery. So a lot of people are saying there is now a risk of a liquidity trap. We're seeing that in terms of what's happening with the lack of appetite for lending. We're seeing that in the credit data. And that's why a lot of economists think the second half of this year is going to be pretty bumpy unless there is a kind of a policy pivot, a fairly major pivot by the authorities. But so far, we're not getting those signals.
And awesome, as always. Great coverage from you and the team on a very complex situation in the world's second largest economy there, and a current there out of Hong Kong. TK, the credit data out of China. That's the bright flashing light for me. That's the most important signal we've seen. Not good.
I agree. And the real estate up and down there has been there for well over a decade. John, I would really emphasize that the outlets that people have for investment within China center around two things: real estate and more real estate. So that's sort of how they got to this mess. And, we play up the abandoned cities, the abandoned skyscrapers. But the fact is, it's a mess. It doesn't obscure the fact that they have a medical plan, if you will, a medical strategy that clearly hasn't worked. I mean, how alone are they in their COVID policy now? Even Japan is trying to open up.
Away from COVID zero, though, Tom, we'd call this the prospect of a balance sheet recession, wouldn't we? Isn't that what we're confronting here?
Their answer is they're going to grow their way out of it if they figure out COVID. I mean, their playbook has always been employ people through exports. That's 30 years of discussion.
Lisa, your take on this?
Well, they wanted to transform away from that. They wanted to create a more domestic economy. And this has been the problem, is how do you do that when you've curtailed that growth and you're not necessarily seeing a smooth run there, especially with the overhang of the mortgage market and everything there. And what you're seeing is perhaps a rockier end to that than people had expected. What are the implications for global growth then, if you start talking about a two-handle, under sub 3?
Can you imagine?
Well, right now this is looking potentially more like you have to game it out.
Commodities, difficult today. We're down by almost 5% on WTI, 87 handle on WTI crude. Coming up shortly, Lisa Hornby of Schroders. Looking forward to that conversation on rates, on credit, on bonds, just around the corner with equities down 0.6% on the S&P. On the Nasdaq, we're down 0.4% from New York this Monday morning. Good morning to you. This is Bloomberg.
I think the market is reacting to the positive sign that we've probably seen the peak in inflation. We've finally seen inflation roll over.
The rally that we've seen in the market over the last month was really just driven by lower yields.
The key is to really focus on two things. It's to focus on valuation and it's to focus on earnings power.
Markets need to be on guard and need to be vigilant.
Everything we're seeing really just a return to kind of economic volatility that used to be the norm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thank you for being with us on radio and television. On a Monday, we recalibrate towards Jackson Hole. We do it with futures off a bit. Oil, John, crushed.
Crushed by weaker data out of China, Tom. Downside surprise after downside surprise, and a central bank response, a rate cut of what? 10 basis points. Bottom line,
Nothing.
Tom, credit data in China, not great. We saw that going into the weekend. What can they do about it? And are they confronting a liquidity trap right now?
We talked to Enda Kerr in there about the opacity of information data. John, the call of the year with the World Trade Organization calling for sub 3% global growth. You got to believe in August we're there.
Weaker growth, but directionally things have improved in the last couple of weeks.
Yes.
We had a monster upside surprise on payrolls. We had a downside surprise on CPI. You put it together, Tom. We said it earlier this morning. Good news for this market was good news. We've had quite a run, 4 weeks of gains, Tom, on the S&P 500.
Now, the VIX 32 down to 21 as well. The makeup of the earnings reports have been quite good. John, I really like what Julian Emmanuel's done over at Evercore ISI. I think it's with 90% plus of the earnings in. I'm sorry, it's been a surprise. What a shock.
You mentioned Evercore, Tom. The work from the rates team, the Fed watchers over at Evercore. Lisa can speak to this, Tom. It's a tug of war right now between this Fed, this market, and financial conditions.
Agreed.
Financial conditions have got so much more easier over the last few months, and it's not just equities, it's credit too. Credit spreads are aggressively tighter over the last 6 weeks.
Let's go into that. Lisa, help me here with financial conditions. A Bloomberg Financial Conditions Index going from one standard deviation grim into a much better negative 0.20, and you see that in IG and high yield as well, right?
It's easy. Yes, you are seeing that across the board. There's been an aggressive rally, to John's point. How much do you say this is foolhardy and that this is a bear market rally? How much do you say there are fundamental reasons for this, in addition to the better than expected or the weaker than expected inflation data, just simply the roll-off that we've seen in commodities? How much pressure does that take off some of the gains? And really, I just keep going back to that. You asked, Tom, earlier, why aren't stocks down more on some of this Chinese data? Well, at what point is it that it reduces demand from the commodity complex, which alleviates some of the tension for U.S. companies?
I'm going to start the data check by saying 104% of our listeners and viewers think oil, West Texas, $88 a barrel, Brent crude, $93 a barrel. I'm sorry. Exactly why is that a bad thing? I'd also note this morning, John, Chicago copper, $356, down 3%.
Down 5% on Brent. And I'd say, Tom, it's a bad thing if it's driven by weaker demand and not greater supply. And I think we can make that read across today off what's happened with China. Yields are lower by a couple of basis points, 281.31. I'd say it's a good thing for this White House who wants to see this carry on. And some gas prices keep going down. Euro dollar 102. Let's call it 102. Negative 0.6%. Some real dollar strength out there off the back of some of this. And futures, Tom, yes, softer, but I'm with both of you.
Yeah.
It's not a major move. We're down 0.6 on the S&P. On the Nasdaq, we're down 0.5%.
The VIX 21.07, out 1.54 points. Some of the tensions off of China this morning. We're going to get a brief now. It's been very visible. Lisa Hornby joins us, head of U.S. multi-sector fixed income at Schroders. And Lisa, I really want to go to a general sentence buried in your note. The value is there for a decade. In bills, notes, and bonds, the value is extraordinary. Discuss that. Why is price cheap in fixed income?
Well, to be fair, we wrote that note about 4 or 5 weeks ago.
And it's moved, fair.
It's moved. But, when we look at bond yields today in the longer term, over the longer term, there is much better value than there has been certainly any time in the past decade. And in fact, if you look back, even going back 20 years, we're at this sort of top 25th percentile or so. And so, in our view, the first 6-7 months of this year have been quite painful in return space. But when you look forward, we've now set the landscape for much better returns. We actually have income in fixed income now for the first time in a while. We couldn't make that case a year ago.
Lisa, spreads have tightened aggressively. You've seen that. We've gone from close to 600 basis points on high yield to threatening to break 400. Lisa, can you help me understand, just dissect that rally for us, where that strength has come from? Is that an up in quality trade? Is it everything? What's happened here?
I think it's a few things. I think the main one for us actually is that people have a bit more certainty in the rates volatility scenario. And what I mean by that is, I think you went back 3 or 4 months ago, people didn't know where the terminal rate belonged. I mean, you heard strategists talking 3, 4, 5, 6%. I mean, there were lots of expectations out there, or lots of various scenarios, and that led to extraordinary high rates volatility, and of course the subsequent impact on credit spreads and equity markets. Because if you can't price the risk-free rate, how can you price everything else? And I think what happened was, not only did sentiment get so poor that positioning was perhaps a bit offside, but what happened was the Fed was perceived to do a slight pivot and show that they are willing at some point to slow the pace down, and that they think that they're getting fairly close to, perhaps a neutral rate at, over long term. But I think people got comfort in the fact that the terminal rate is probably not 5 or 6%. It's probably 3 or 4%.
But Lisa, the Fed has said we haven't pivoted. No pivots going on here. And basically, we're expecting to hear that in the minutes. Is that going to reverse some of the spread tightening that we've seen?
I think it will. I think that the market narrative shifted a bit, and that lower vol regime is positive for risk assets. And especially, it's more positive when sentiment had gone so far offsides. I mean, we look at that Credit Suisse panic euphoria index. It was -5 panic for months almost. Now it's back actually in positive territory. So there was a massive swing in sentiment. I think that, coupled with that perception that the Fed became a bit more perhaps dovish, led to the rally that we've seen. To your point, Lisa, in our view, this is a fade. I don't think the outcome that the market has painted, which is one, if you look at what's priced in, the yield curve is inverted. That points to a recession. You look at what's priced into Fed funds rates. It's basically the Fed stops in February or March hiking, and they basically do an about face and start cutting rates in the summertime. I think that's a fairly unlikely scenario unless there's a really big downturn, which there could be. But then should risk assets be priced the way that they are today?
Lisa, are bond markets as well as the Fed all just trading and operating around an oil market that's in flux?
I think oil is one part of it. Certainly, that's going to lead to the headline inflation sort of gyrations. I mean, oil came off, and so we saw a big drop down in CPI, headline CPI. But I think core inflation is more important, and that's really where the story is. And to us, that's a bit more concerning. Yes, there was maybe a little bit of moderation, but the sticky components of core inflation are still running north of 5-6%, and so. To us, that's the real challenge. Yes, oil will have puts and takes that will drive headline, but you got to get core inflation down to more reasonable levels, and I think that's what the Fed is focused on.
Lisa, just listening to that final comment there, that just sounds like you think this debate over terminal rates is unresolved, that it's too early to get ahead of this story.
I think it's too early to be discounting Fed cuts, certainly. I think it's too early to be discounting the Fed has pivoted. I think that's not done yet. I do think that they probably moderate their pace in September to 50. Probably, they could do a couple of 50s. They could do a couple of 25s. I don't think the 5 or 6% story is the one that, people were fearful of at the very front of the year. I don't think we're getting there, but I think the market is pricing in this very specific outcome where we head into a very moderate or mild recession, the Fed is able to stop hiking and then start cutting, and that just seems unlikely. Historically, they don't cut when inflation is at elevated levels, unless growth is really, really bad. Unemployment, is much higher than where we are today. So, I think the market is getting a little too excited right now, to be completely fair.
I've always called that, Lisa, a bedtime story to help equity market bulls sleep well at night. And that's what that is right now. Lisa Hornby there of Schroders. Lisa Abramowicz is just this really cute story about how this is all going to play out. Deutsche Bank did a great piece on this going into the weekend. If you get inflation to moderate, you allow terminal pricing to come down. Maybe that's what we've seen. But I don't think you could equate peak year-over-year inflation with this idea that we've seen peak Fed hawkishness and then soft landing comes after that. There's a lot of things that we still need to resolve here. One is whether inflation is going to remain really sticky into year-end or not. And that's going to reintroduce this debate about whether we really can price out terminal pricing in the way that we have, Lisa, in the last couple of weeks.
And this goes to the question of the core rate, which we did not see decline as much, and rents and some of the wage increases that we continue to see, which should be, all other things being equal, a good thing. But in this case, pretends perhaps a stickier inflation rate going forward, not something the Fed's going to want to see.
Too cute to price in rate cuts, Lisa, seems to be the takeaway for many people. Tom, futures are down, dollar stronger. What are you seeing in FX?
What I'm seeing across here is a search for joy. As you mentioned, John, we had job joy, we had CPI joy, and I think to reaffirm what we've seen for 4 weeks, you got to find the next economic joy. Maybe that awaits in the retail sales report. What I really see is a real sense of risk out there, witnessed by Euro Swissy, has just legged stronger. And John, is back to our yield of 2015. We're getting near on Euro Swissy 0.95. We're not there yet, but we're getting there rapidly.
I can't decide whether that's depressing or not, Tom. A search for joy.
I think it deserves a remote from Brasserie Lip.
Spoken like someone who hasn't taken enough vacation time.
Search for joy.
That's all I can say.
Take some time off, Tom. We can arrange it.
No, I'm not taking time off.
No?
I don't have a life.
So American of you.
I have children.
Futures down 0.6 on the S&P with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Another U.S. congressional delegation, this one led by Democratic Senator Ed Markey, is visiting Taiwan. China says it is fighting back by adding more military patrols around the island. The congressional trip comes less than 2 weeks after the one by House Speaker Nancy Pelosi, which led to unprecedented Chinese military exercises. Now in China, the central bank unexpectedly cut its key interest rates. The People's Bank of China is ramping up support for an economy that has been hurt by COVID lockdowns and a deepening property downturn. New data shows that home prices fell again in July. Meanwhile, industrial output and retail sales were weaker than expected. Members of Congress are putting pressure on the U.S. government to tell them what was in classified documents seized at the former President Donald Trump's home. Senate Intelligence Committee leaders have made a bipartisan request to the Justice Department and the Director of National Intelligence. They asked for an assessment of potential risk caused by the documents' mishandling. Iran is promising to respond to a draft text to revive the 2015 nuclear accord by tonight. Iran's foreign minister says if the U.S. shows a realistic approach, there could be an agreement in the next few days. A deal could let Iran resume oil exports to global markets. It's a giant shift for Wells Fargo. The bank that once churned out 1 in every 3 home loans in the U.S. now plans to shrink its vast mortgage empire. Bloomberg has learned Wells Fargo is no longer committed to ranking #1 in the business. That comes after years of struggles to avoid costly probes and hits to the bank's reputation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
This year, we're probably lucky again to see 2 to 3% growth in the Chinese economy. Once Xi Jinping gets through the 20th Party Congress this October, November, Will there be a course correction on the economy or not? And that'll depend largely on who gets appointed as Premier as head of the economic team.
Bam, risk on. I mean, I wasn't even listening
Really?
to Kevin Rudd there.
Really?
Kevin Rudd's great, the former Prime Minister of Australia. I was listening to Bramo in that promo, Tom. Bam, risk on. Said with so much hate within just despising the
Okay,
move.
come on.
Futures down 0.5%. I'll let it go. The Nasdaq 100
you
down
won't.
1/3 of 1%. I won't. Although I've been terrible in those promos too over the last few months. Yields down 2 basis points, 280 on a 10-year. Bit defensive out there. Data out of China, ugly. We've got crude down by more than 5%. Tom, 87 handle on WTI.
And the nuance here, John, let's go into this right now. It's important. The bit defensive part, John, I would suggest is in commodities. They just ebb away through the morning.
Totally, Tom. Copper out of London on the LME, down about 2.5% this morning too.
Yeah, and we see with some dollar resiliency. I'm watching sterling 120.86, which bears watching, maybe a bit idiosyncratic to say the least. This is well timed. Elaine Camargue joins us right now, senior fellow at Brookings, definitive on presidential history and the cadence across decades. Elaine, I want to go to your glorious colleague, one William Galston over at Brookings, who has written a timely piece of which you are expert on. Is an exhausted America, whatever our politics, are we ready finally for a third party?
My dear colleague Bill posed an interesting question, but I think he also answered that question, which is we are not ready for a third party. Third parties don't succeed in American politics because of the basic structure of American politics. We have winner-take-all systems. So picking up a couple seats here or there, coming in second, coming in third, as you would in a parliamentary system, gets you nothing. And so the real effect of third parties historically has been simply to detract from one party or the other. And historically, third party movements have then been incorporated into one of the major parties. That's it. It won't work. It never has worked. It won't work now.
You are expert at the sprawl of our history. I mean, folks, this is someone who can tell you what actually happened in the 4 years before Grover Cleveland's effort. I mean, to be direct, Elaine, has it ever been this divisive in the country, or do we all need to read up on alien sedition in 1802?
Well, remember, we had a civil war. You don't get much more divisive than a civil war.
We mentioned it earlier, yeah.
Yeah, I mean, so yes, we are in a period of extraordinary divisiveness. It even has aspects of violence around it, which is frightening. But we have been through these periods before and survived, and hopefully we're not headed to a civil war.
Elaine, you have 3 different prongs right now that are really dominating the headlines heading into midterm elections. You have, on one hand, gas prices going below $4 and just the general inflationary environment that does seem to be cooling just a tad, at least for certain items. You have the social issues with the abortion ruling. And then you have the latest bombshells around Trump and some of the papers that were confiscated from Mar-a-Lago. What are you watching most closely for what could impact more significantly the midterm elections?
The most important thing I think I'm watching is the abortion intensity of the people who are appalled by the Supreme Court abortion decision. We saw an early indication of that in Kansas, where on a referendum, there was presidential level turnout and a 20-point victory for the pro-choice side. I think there's a lot of pent-up anger about this, and I think we're going to see it as these midterms roll out. The economy was already baked in. In other words, if you were a Republican, you thought this economy was terrible. If you were a Democrat, you thought it was bad. Didn't think it was Joe Biden's fault. So that was already baked in. And of course, the Trump supporters, they love Donald Trump no matter what he does, you know, taking state secrets home and jeopardizing security. They'll make an excuse for it. So those other 2 things were baked in. The new factor is the abortion decision. I think it's going to have a lot more energy, lead a lot more energy for the Democrats than we ever thought.
So, Elaine, work that forward going to the midterm elections. How do you think that's going to shape the outcome in a way that perhaps is unexpected?
I think it'll help the Democrats keep the Senate. I think that's the big takeaway. The combination of the abortion decision and the Republican choice of some less than great candidates. And the two I'm thinking of are Mehmet Oz in Pennsylvania and Herschel Walker in Georgia. I mean, the Republicans had better choices than they ended up with, thank you, Donald Trump. So I think that the combination of the energy around abortion and some poor choices probably bodes well for Democrats keeping the Senate. The House, I think the Democrats will still lose, but I don't think it's going to be a tsunami. I don't think it's going to be a 63 vote margin in the House. I think it'll be a much narrower margin than people are expecting.
Elaine Kmark, Elaine, thank you. Appreciate your perspective. As always, Elaine Kmark there of Brookings. Tom, certainly if I was to pick out one point right now, it would be in the commodity market, not just with crude lower today, but just gas prices coming down the way they have done, Tom.
Yeah, is that a bad thing?
I think it's a good thing for this White House. I think we can say that, Tom, without a doubt.
I agree. I mean, I really got to be careful here, John, because while you were gone on your one-day holiday that turned into a week, I mean, I got to be honest, John, the level of gloom I'd never seen. It was amazing.
Where was the gloom coming from?
Strategists, guess, whatever. World's coming to an end and all that.
He could be
Boom, up we go.
Was there tension?
There was tension. Yeah,
Whilst the family
between me and
therapist was
Bramo,
away last week.
huge. You know,
Okay.
you know, Kaylee Lines.
Did we resolve any of that?
No, of course we didn't. As well. John, can you explain Manchester United, the thing of the weekend, and translate this for the American audience? Here's this venerable firm, which we know through Jim Lord O'Neill. Okay, great. I've never seen the essays on Man U and their collapse like I've seen this week. What's happened?
The ownership of the club is where the focus is at the moment, Tom, but I don't think it should just be on the ownership of the club. Those players, Tom, are not performing at all, and they've got a really tough game next week against Liverpool, and that could be 3 losses. 3 losses lining up to start the season.
But is this like equivalent, seriously, to the Yankees being in last place? I mean, is that big a deal?
It's not just the Yankees, it's the Cowboys, it's the same thing. It's a massive franchise, and they just haven't been able to get any success whatsoever. But the Glazers, Tom, that's where the focus is. They have not had the success at Man United that people wanted to see. The company, we can call it a company because it is one, has been loaded up with debt.
Yeah.
They've spent a lot of money on players, and those players haven't delivered.
I'm so dumb. Is Man U Liverpool next Monday? Is that a derby?
That is considered somewhat of a derby, but it is not a local derby in the sense that they're not from the same city, Tom. But it is a big, big game for the country.
It's like Phillies Mets. It's
Does
not
that work?
really a derby.
Okay, I don't think that worked. Anyway, futures are down. A little bit of economic data in America just around the corner. Mike McKee's dropping by to get you up to speed on that. Good morning to you. Futures are negative. We're down 0.5% on the S&P. On the Nasdaq 100, we're down 1/3 of 1%, and that is an ugly, ugly number. Mike McKee, walk us through it.
Yeah, we don't normally give the Empire Index a lot of airtime, but today Empire has absolutely collapsed for the month of August. This is the first major manufacturing indicator that comes out during the month, and it's down 31.3 points, down to 31.3. I'm sorry, that's a collapse of 42 points. It fell. The numbers show that only 12% of respondents indicated conditions had improved during the month. 44% say things worsened. New orders fell 36 points to 29.6. Shipments fell 49 points to 24.1. Even employment fell 10.6. It's still positive at 7.4, but that's a very low number. The only relatively good news, prices paid falling 8.8 points to 55.5. But this is the second largest drop in the Empire Index in its history, only behind what happened right when the pandemic broke out in April of 2020. So a major fall in the numbers for the Empire Index. Kind of a tertiary index, but it is a very interesting drop.
Well, the bond market, heard you, Mike. Yields are lower by 5 basis points on a 10-year to 278. Equities are doing okay still, basically where they were. We're down 0.5% on the S&P, but certainly a reaction in the bond market to some of this. Commodities already lower off the back of the terrible data in China. Mike, the regional Fed manufacturing readings have been pretty rough for a time now. For the last couple of months, Mike, how does that stack up with the other data points, the ISM, the PMIs?
Well, it's interesting because the PMIs have been down. We've seen that, but the ISM numbers have remained in positive territory, and there hasn't been a great explanation for it at this point. But it does suggest manufacturing overall is slowing down. Even the ISM numbers have come down some, but the economy still has some residual strength. We get Philly Fed later in the week, and I'm sure that will garner a lot of interest after this one now.
Mike, how much is this being perhaps a little bit distorted by the inventory build that we've heard so much about? The fact that a lot of companies and and retailers have needed to hold on to more to avoid the kind of disruptions that we saw immediately after the pandemic started.
Well, it may have something to do with it. It's a little hard to necessarily put it on the auto industry, on the inventories, in the sense that New York is not a big manufacturing center for garments and things like that. So it isn't the centerpiece of what's been happening with inventories. But they show inventories are not coming down. So it's still some bad news there that is going to have to be worked through.
Sending yields lower, that's for sure. At the front end, we're down about 4 basis points on a 2-year. Let's call it 320. On a 10-year, we're down about 5 basis points to 278. Equity's okay. We're down about 0.5%. But TK, that data, ugly. No other way of putting it. Off the back of some weak data out of China earlier this morning.
Yeah, and making even more important the retail data that we're going to see later on 70% of the economy. My keynote there, John, is it's a tertiary piece, but nevertheless, the magnitude of that move is jaw-dropping. Right now, we're going to rip up the script. We can do this with William Lee. He is chief economist at Milken Institute. We are going to talk to him about the empire statistics, but said, let's take advantage of his encyclopedic knowledge of the Pacific Rim and the dynamics of China. Of course, Dr. Lee has all of the efforts he's done at the International Monetary Fund over the years, and Citigroup, and of course has a shingle out at the Milken Institute right now. Billy, I want to go to the party Congress right now. Elizabeth Economy of the Council on Foreign Relations, in her beautiful book, The World According to China, has the view of China looking out. How does Beijing and their leader in Beijing, how does he look within, giving the grim data of the day?
Actually, President Xi has made a major campaign of his to start looking inward. It's called the dual circulation strategy, where he wants to have the domestic economy become the primary focus for China and the source of growth going forward. Unfortunately, so much has collapsed within China that the domestic economy is nowhere to be found, especially in the private sector, where the only store of wealth the middle class had, the property sector, has completely collapsed. We've had about a year of declining real estate prices. So right now, the rest of the world is the only hope for China, and even that's collapsed because the latest data show the export numbers are nowhere to be found. So China really has nothing to hang on to going into the party Congress.
How does Xi, Bill Lee, prosecute decisions, logistics, the process of it to Shanghai or to Chengdu? How does Beijing actually get the message out?
You know, right now there's a tension between the central government and the municipal governments. Because right now, the only place for revival is to have the municipal governments go in there and do infrastructure building and just start pumping out fiscal policy. Unfortunately, every municipality out there is so indebted they can't do it. And so the only thing that Xi Jinping has to have to save face going into the Party Congress in October is to have some prayer of saying we will have a revival in the second half of the year. These numbers today have put that to rest, and there's no chance for that. On top of that, Speaker Pelosi has slapped him in the face, and the loss of face going into the Party Congress is going to be something that's going to be very hard for him to recover from.
Bill, we'll get to Taiwan in a moment. Just on the economy, are you describing a balance sheet recession in China?
A balance sheet recession for sure in the private sector, because the only source of saving for the households has been real estate and a very volatile stock market. And so with the collapse of the real estate market and the huge youth unemployment, it's very hard for households to have a positive outlook for the future and start buying things like consumer durables and other items. So the balance sheet recession notion is very much in play in China.
That leaves monetary policy impotent, doesn't it? And Bill, if that's the case, I'm just trying to work out where that leaves the global economy off the back of these dynamics starting to bubble to the surface just a little bit more.
The only place monetary policy can have a play here would be regulatory policy, to somehow ignore all of the holes that are in the real estate sector and say, okay, guys, go on and build. We're going to backstop all of your bad debt and all of those empty apartments of yours. That's the only place for monetary policy right now is the regulatory side. And China's not going to be able to do that because the regulatory sector, the real estate sector is in such bad shape.
So what are we looking at, Bill, in terms of GDP growth for China?
I hear two handles going into the rest of the year. And so in order for China to get to its 5.5% target, it has to have 7 and 8% for the rest of the year. And right now, it's exactly going the opposite direction.
Has the rest of the world economy factored that in, the likelihood in your idea that you could see a two-handle for Chinese GDP growth?
I think that notion has gotten out, especially among my friends who are China chief economists out there. They can't publish it because they'd be banned from China. But I think the notion is among the investors of the world, well, this may be temporary and that China will somehow recover because it always has. But the structural problems I just pointed out are just so severe, I think there's going to be a lot more work to be done for China to regain anywhere near its investor status.
What about the asset pricing, though, globally? And we're just talking about the Empire Manufacturing Survey, severely disappointed. Second biggest drop in this history of this index, the second biggest just all-in level that we have ever seen in this index's history. How much are we looking at a global recession really pitting off the slowdown in China?
Well, manufacturing is really at the core of the globalization. That's the one sector that's most affected by globalization, and China in particular, because it's been the nexus of manufacturing. So we would expect any kind of slowdown in China that affects the global supply chain to kill the manufacturing sector before anything else, and we are seeing that in the data now. So that's not so surprising. What is going to be difficult would be how the rest of the global economy will adapt its global supply chains in a way that it takes China out of the picture, or at least become less important part of the picture.
Bill, you said something moments ago. I'll paraphrase, that certain people can't publish things because they'll be thrown out of the country. Now, Bill, there's an element of truth in that, in the minds of a lot of people. And I wonder if these things start to deteriorate just a little bit more, Bill, where I look for reliable data on what's actually happening in that economy.
Well, I hate to say this, but my sell-side colleagues are kind of constrained. I'm lucky to be at Milken where I'm not constrained to say what I think. And I think it's going to be very difficult to find hard intelligence about China outside of private sources.
That's tough. Bill, thank you. Bill Lee of the Milken Institute. TK, that's what we've got to confront. These dynamics, these issues that we're talking about right now, Tom, are things that we typically associate with a balance sheet recession, which is what Bill's talking about in the Chinese economy.
Yeah, it can be a balance sheet recession, but I think it's so unique, and you see it with the information flow there, the lack of clarity on data as well, that I'm in the camp, John, it's more than just an economic analysis. It's a unique time. I don't have any ability to predict it other than to say I could see the three of us traveling to Shanghai in November to cover the party Congress.
Are we going to be able to talk about what's happening in that economy? Do you hear what Bill Lee just said there? That he doesn't expect to get the real insight from his South Side colleagues.
No, that's been known for years. And
sure, but how problematic is that as we confront some real issues in that economy?
I think that Dr. Lee is speaking the reality that is unspoken by anyone on Global Wall Street that's experienced. John, I've personally experienced it numerous times in China.
There's a larger question here, though, which is our economists that are looking at the U.S. manufacturing, that are looking at the U.S. factories, the U.S. Retailers factoring in a 2-point-something GDP for China. How do you then factor that in? And if that's the case, are oil prices reflecting something that other risk assets are not yet because of the slowdown in demand? And that, I think, is a bigger sort of question for markets.
Empire Manufacturing was brutal, wasn't it? Good to catch up with Mike McKee off the back of that. I can tell you off the back of it, futures still lower, down about 0.6 on the S&P, on the Nasdaq 100, down 0.4%. Where we saw the response was in the bond market. Yields down, heading south, lower. Negative 4 basis points on a 10-year to about 278, let's call it 279, and lower at the front end of the curve as well. Coming up in the Open, looking forward to getting the seat back from Bramo.
Claim your territory.
Lisa was, maybe Tom going to take it away from me.
Oh, right.
Do you want it? You can have it sometimes if you want. Victoria Fernandez of Crossmark's going to join us. James Athey of Aberdeen Asset Management and Jill Carey Hall of Bank of America. Looking forward to doing that and maybe just injecting a little bit of optimism after I don't know what happened last week. Lisa, was the balance in the conversation last week?
It was completely balanced.
It was
just absolute
fair and balanced.
gloom, gloom, gloom.
As we count you down to the Open
What's the
and
counterbalance?
From New
Gloom
York.
and balanced.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. China has added military patrols around Taiwan after another U.S. congressional delegation visited. Beijing said it was fighting back against the trip led by Democratic Senator Ed Markey. The visit comes less than 2 weeks after the one by the House Speaker Nancy Pelosi that set off an unprecedented wave of Chinese military drills around Taiwan. Russia's President Vladimir Putin is offering to expand relations with North Korea. Putin sent a message of congratulations to Kim Jong-un's regime for its Liberation Day holiday. North Korea has been stockpiling artillery for decades. That has led some analysts to speculate that it could supply weapons for Russia's war in Ukraine. The UK has granted the world's first approval for a COVID vaccine tailored towards an Omicron variant. Moderna's updated booster contains a half dose of its original shot and the other half targeting an earlier version of the Omicron variant. The company says the vaccine has also been found to generate a good response against the latest sub-variants. Saudi Aramco has posted the biggest quarterly profit of any listed company. Aramco followed other big oil rivals, reporting a surge in earnings due to high crude prices. Net income rose $48.4 billion in the second quarter, almost double what it was a year earlier. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What I think the market wants to see here is it wants to see two things. It wants to see the inflation genie going back into the bottle, and that's somewhat obvious. I also think that the market wants to see some deterioration in the labor market.
David Leibowitz at JP Morgan on inflation genie back in the bottle. And right now the inflation genie is back in the bottle because oil, Lisa Abramowicz, oil now plunging well under $5, 5.6%. West Texas Intermediate moments ago dipping under $87 a barrel. Lisa, that gets your attention.
Especially after the Chinese data that came out overnight that were weaker than expected, with Bill Lee of the Milken Institute just coming on and saying it is very likely to see GDP growth in China in the two-handle level, very much opposed to what you're hearing from the Main Street, Main Street economists.
Let's parachute in a perfect time when Gina Martin Adams, chief energy, buy it at $124 a barrel analyst at Bloomberg Intelligence, running all of our equity coverage. The last 10 days, I've been shocked by the amount of gloom, interview to interview, that I've read. Is sentiment still gloomy? Or have we had a bull market in equities where the gloom has drifted away?
Yeah, it's so difficult to measure, frankly, because one of the things that I think has really surprised the consensus all year this year is the degree to which the investor is willing to persistently invest. Flows into the equity market have been somewhat stable and significantly stronger than many people had anticipated in an environment where, well, they usually do. Usually one of the indicators that you find is as the market is falling, the investor is capitulating and flows are negative. And that is a confirmation of very negative sentiment. We've missed that this entire cycle. And the reason I think that they've stopped is, frankly, they've learned some lessons from the last several corrections, in which the investor has largely taken money out of the equity market at exactly the wrong time, struggled to get back in until the equity market was already somewhat overvalued, and really mistimed it. So hopefully some of this is a reflection of the education of the investor population.
I want to move away from sector analysis and bull and bear analysis to factor analysis.
Sure.
Do we have factors out there that will allow a part of the market to be bully-like even if the rest of it is berry-like? Is there factors that allow, for example, quality large cap to do better than good?
Well, so far this year, the factors that have done incredibly well is value. The value stocks, the long end of value relative to the short end of value has outperformed tremendously. Quality has actually been an underperforming factor because quality is closely linked to low value, right? Quality stocks tend to be the most expensive stocks in the market. Those have performed very, very poorly over the course of 2022, reflecting a new inflation outlook and rising interest rates. That said, the factor that really screens as somewhat attractive to us in our factor work right now is still momentum. Momentum stocks doing very well relative to the other factor families, and low volatility also doing relatively well. The combination of value and quality is very messy as we contend with this environment of peaking inflation and still rising interest rates.
Which is the reason why, Gina Martin Adams, so many people are just looking at the Fed and saying it all depends on what's going to happen with interest rates, and that the rally that you've seen in big tech, which has really driven the gains that we have seen, is off the heels of this ratcheted back expectation for how high yields can go. How much can we really attribute that to the rally versus what Tom is talking about, which is faith in the ability to continue to grow profits at a time where they've been incredibly resilient?
I think it's entirely due to interest rates, frankly, Lisa, because this group, even though profits are somewhat resilient long term, this is a group that is showing the greatest negative estimate revision in the S&P 500. So when we look at the big cap TMT stocks, in particular those that are more communications focused as opposed to the Apples and Microsofts of the world, those stocks are producing the greatest negative estimate revision in the S&P 500. At the same time, they're reinflating. So that would tell you that the entirety of the market sort of movement in favor of these groups specifically is related to the outlook for interest rates and some pullback in expectations, or at least a full pricing of expectations for the Fed. Now, keep in mind that when we looked at this back in June, these stocks were inordinately cheap relative to their long-term average. They're now somewhat expensive, trading at about a 20 handle on forward earnings relative to their pre-pandemic 5-year average of 17.5. So this is a group that is now somewhat expensive. If the Fed does move to the degree that the market is anticipating, we would expect this group to trade closer to 15, maybe 16 times forward earnings on a longer-term basis. That's a far cry from where we are today. So I think this is still a group that exhibits some degree of risk and probably creates some downside pressure in the short run as we rotate to more sustainable gainers over the longer term.
What's the next pivot point then for equity traders that are looking to the Fed?
Look, I think the next pivot point is obviously the next Fed meeting. That said, most people are largely anticipating somewhere between 50 and 75 basis points over the next meeting. The really big question marks come into play into the end of this year, because there are a lot of folks that think the Fed won't hike pre-midterm election. There are a lot of folks that are counting on economic data sort of deteriorating significantly following Labor Day, and that creates something of a pause at the Fed by early 2023. Will that actually happen is a huge question mark. The Fed themselves also appears to be getting a little bit frustrated with the degree to which the market has traded post the last Fed meeting, and is being very vocal in suggesting we are not going to drop the ball on this. We have very strong conviction with respect to policy and really battling the inflation genie, if you will. And so the Fed is guiding us to expect themselves to remain very vigilant and very hawkish.
I get 30 seconds on a Monday and nobody's watching because it's August, it's sleepy and that. Everybody got wrong the resilience of revenue and earning growth Q2.
Yep.
Why is Q3 any difference?
The biggest difference going into Q3 is that much of that revenue and earnings growth resilience was due to the commodity space. And since we've gone through the course of second quarter earnings, we've seen commodity prices pull back tremendously.
Yes.
So there's been a lot of rotation out of the commodity trade and price capitulation in commodities, which may risk the outlook in the short run for some of those more resilient segments of the market. And then we've got a lot of inflation volatility to contend with still in the second half as well.
Gina Martin Adams getting us started on a Monday here. Thank you so much. Lisa, down $5 on an oil barrel. What are we going to get? We're going to get under $3 on a gallon of gas? We're halfway there.
Well, we're hearing from this administration that they expect oil prices to continue to decline with gasoline following. How much does that really hinge on what we saw overnight from China?
I'm going to call it a new low for the day. Futures at -30, Dow futures at -221, and the VIX 21.14. What an interesting Monday, setting us up for retail sales on Wednesday. Please stay with us. This is Bloomberg.
Welcome back to a special Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Jamie Maggio. The stars of the ATP and WTA tours head to Cincinnati, the final stop on the road to New York. Daniil Medvedev heads into the tournament needing just 2 wins to secure the world #1 ranking through the U.S. Open. But the 26-year-old could face Jenson Brooksby in the 3rd round before potentially running into the red-hot Nick Kyrgios in the quarters. Rafael Nadal returns to the tour for the first time since Wimbledon, and the Spaniard could deny Medvedev the top spot if he lifts the trophy next weekend. On the women's side, look no further than the blockbuster first-round clash between Serena Williams and the reigning U.S. Open champion, Emma Raducanu. The 23-time major winner recently announced that she'll retire from tennis after the final major of the year at Flushing Meadows. I'm Jamie Maggio.